Thank you. I will.
Seats. Hello, everybody, and thank you for sticking around. I hope you enjoyed lunch. We're going to get going here. I'm going to give you a minute or two to finish your conversations because I don't want to interrupt anything that's consequential that's going on. Make sure you trade business cards and commit to following up with each other after the conference. Certainly after we're done today, there's some great bars in town, just a few blocks away. You can walk down to have a cocktail as well, or grab some dinner tonight if your plans don't take you back home. We do appreciate everybody that's watching online. We do have a great virtual audience that's tuned in and dialed in. I want to encourage everybody that's watching online to take the time to reach out if one of these companies are interesting. Send them an email. Almost everybody has their contact information on their last slide. So be sure to reach out and contact them. So we will get going here in just a couple of minutes. And I appreciate you all sticking around. We have some great companies that still have to present this afternoon for us. So looking at the afternoon agenda, and we do have some wonderful companies, great ideas. If you are an EV supporter, we do have a revolutionary battery technology company coming up, water recycling, materials science, another fintech company. So please stay with us, and we'll get Ron up here with Aureus just here shortly. Well, thank you guys again very much. Our next presenter with Aureus is Ron Hosjan. He is the Vice President and CFO of Aureus. Incredible ideas and solutions in around water recycling. We know that on the ESG side, if you are a producer, what you do with fresh water and how you recycle is extraordinarily important, and Aureus has a solution for that. So welcome, Ron.
Thanks, Dan. I'd like to take the opportunity to thank EnerCom and School of Mines for hosting this event. I think we've all heard a lot of great ideas today, and look forward to the afternoon session as well. So we're going to switch gears here and talk about water conservation. These are some headlines that we've been seeing in the press over the last year and a half in Texas, New Mexico. There's all kinds of movements to reduce disposal. There's some discussion that's linked to seismicity issues that are going on in Texas. And of course, New Mexico, no secret to anyone, they do have a freshwater shortage. And there is a lot of discussions about reducing and even banning freshwater use in the energy space in that state. So how can Aureus help? Aureus's technology is changing the way our customers view their produced water. Customers historically viewed their produced water as being an expense, a cost of getting rid of, and our technology is going to change their views into causing them to view their produced water as an asset that's reusable many times. So not only can our proprietary technology reduce water handling costs by up to 50%, but we eliminate the need of adding fresh water for fracking purposes. That's a very key part of our technology. So a couple things that set us apart from existing technologies. You know, our technology is centered around these treating vessels that are enclosed and pressurized. We can treat up to 20,000 barrels a day per vessel, which significantly reduces our on-site footprint. Proprietary chemistry customized to meet water quality needs of our customers. Our sludge extraction system creates 60 to 70% less waste than competing technologies, which is also very important to our customers. Our zero emissions vapor control allows us to remove the standard things out of water, such as iron, lead, hydrocarbons, but it also allows us to remove H2S from water, which is, again, something that our competing technologies aren't able to do. And our real-time continuous SCADA monitoring also keeps our customers informed on water quality, flow rates, and all kinds of important information when they're executing a frac program. So how is Aureus changing the game? Besides saving our customers up to 50% on the water handling costs, we can treat produced water on the fly, which has almost zero retention time. Again, because of that, our vessels can recycle 20,000 barrels a day per vessel, which significantly reduces footprint on site. Our fleet is also mobile, so we can right size, increase capacity and decrease capacity to customers' needs quite easily and cost effectively. Our technology can recycle every barrel of produced water that's sent to us without the requirement of adding fresh water. A lot of our competing technologies require the addition of fresh water to dilute produced water to meet KPIs such that it can be reused. Our technology eliminates the use of fresh water. We don't need to introduce any fresh water to our system at all at any time. So Aureus, we believe our opportunity has been set up perfectly over the last couple of years. You know, disposal volumes are hitting all-time highs, and very little of produced water is actually being recycled. I think 2022 forecast was in that 25 to 30% range of produced water is forecast to be recycled. Historically, our industry has done a very poor job in recycling produced water, and most of it's been going into the disposal side of this. Busy slide here. The left part of the slide is current industry practice. I'll just talk to that very quickly. Historically, companies would drill a well, bring production on, and all of that water would get disposed, only for that customer to then go and buy fresh water to frack additional wells. Very inefficient and very costly process. Our technology allows us to touch every barrel of produced water, whether it's flowback, whether it's produced water. We can recycle it. We also offer additional services such as disinfection services, and we'll even move the water for the customer as well. So we're your one-stop shop for water handling, recycling, and you know, that critical mass and economies of scale, all those benefits are passed on to our customers in what we're charging. We're currently building infrastructure in the Permian Delaware. We have current capacity of about 500,000 barrels a day. We're looking at growing our capacity to a little over 1 million barrels a day by year end. As of just 4 or 5 months ago, we only had 2 recycling facilities operating. One was in the Permian, one in the Delaware. As of today, we have 5. facility is operational. And we're adding another one here in the next month. So we're currently financed appropriately for the first half growth, but depending if we continue growing at the speed that we have the last 3-4 months, there may be a need for additional investment here in the back half of 22. The picture on the left is our first ever commercial recycle hub that we just brought on stream here in January. Very proud of the small footprint. You can see that our four vessels. Is this thing a pointer? There's our 4 vessels there. So that's the footprint of our technology. And that facility there is good for about 50,000 barrels a day, as is. A little bit about Aureus. What are we about? We live by our mission, vision, values. All of our staff are committed to upholding our values. They're listed there on the slide. In the absence of time, I won't go through them all, but all of our employees live by this mantra on a daily basis. This is how we measure our staff's performance is based on how they're upholding these values and alignment with the vision of the company. Here's our leadership team. Again, not to go into too much detail here. There's a lot of gray hair and a lot of experience in the water space, and we're pretty proud of the team we put together here in Midland and in Calgary, and look forward to their successes here in 22. So in the essence of time, thank you very much, and I'll be around all afternoon if anyone has any questions. Thank you.
Awesome, Ron. Thank you. I want to encourage everybody to reach out, talk to Ron. Certainly, again, recycling is a critical component of oil and gas production, and certainly something that is ESG oriented. I mean, it was great to see and to hear a lot of the conversations this morning over lunch. It's a great opportunity to exchange ideas, obviously, with other people. And it is good to see people and meet in person. There is a dynamic here that we've been missing for a couple of years. So it's good to see everybody. And it's great to talk to people. It's great to interact and do that networking. I think it advances good ideas. Our next presenter, Michael Rosenberg, is the CEO of Creative Battery. And I'm looking for him. There you are. All right. There are a lot of talks about EV, a lot of talks about renewable alternative energy storage, and Michael definitely has an idea on how to make batteries more affordable and certainly more competent. So, welcome.
Thank you. As Dan said, I'm Mike Rosenberg. I'm the CEO of Creative Battery. And we are an advanced battery technology company. We're developing a 3D rechargeable lithium ion battery. We have working prototypes. We've got a fairly significant IP portfolio, especially for such a small company. We have 28 patents issued covering 7 distinct inventions. We're targeting all the large markets. We have 2 strategic partnerships to date, one with Stanley Black & Decker for power tools and lawnmowers. And then we have one with Hercules electric vehicles for pickup trucks and recreation and marine. So why lithium ion batteries? You guys probably all know this well enough. But today, the lithium ion battery market, or lithium ion battery market, is about $50 billion. We think it's going to grow up to over $200 billion in the next 10 years. So it's a massive market, and we do need better batteries. You may think lithium ion batteries are good enough. where they are today. I mean, they are in electric vehicles, they're in cell phones, they're everywhere. But they're not good enough. If we're going to go to a full electric vehicle market, we need better batteries, because today's batteries, they lack the range. They take too long to charge. They don't operate well at low temperatures. There's issues regarding safety with regards to thermal runaways and fires. And they're too expensive. So they need to improve. We need to address all those key issues if we're going to get to a 100% electric vehicle market. And there's an unprecedented amount of investment going into the market today. This is just a sampling of the investments that companies have announced that they're going to make over the next 4 to 5 years. Hundreds of billions of dollars going into the electric vehicle market and the battery market. And I was just talking to a colleague here at the conference, and this is a massive change in the automotive industry. If you don't have a battery and that somebody else has a battery that works and then delivers all the things we just talked about, of fast charging, operations at -30, being able to charge in 3 minutes. If you have that and nobody else has it, you're going to grab a significant amount of market share. And if you think about it, Tesla right now has got like 80% market share in the electric vehicle market. They think by 2030, 2035, they'll have 20%. Where's that 20% coming from? Is it coming from GM? Is it coming from Ford? Where's it coming from? And I think what you saw on Super Bowl Sunday is the start of the market wars on electric vehicles. This is just starting. The amount of money that's going to go in this is just absolutely unprecedented. So let's talk about batteries. Typically, lithium-ion batteries and most all batteries are two-dimensional batteries. You have an anode and a cathode, and then lithium-ion travels between the two. And typically, what you have is a choice to make. You either have a high energy density battery or a fast charging battery. You can't have both in the same battery. So for high capacity, you put a very thick anode and a thick cathode, but then it takes a long time for that lithium ion to go back and forth. So it's really slow. If you want a fast charging battery, you make those layers very, very thin. Lithium ion can go back and forth between the layers very quickly, but you don't have very much anode cathode there, so it's a low capacity battery. What we've done at Creato Battery is we've taken and developed a 3D architecture. So basically combining both of these two things into one battery. So you can have high energy density and fast charging in the same battery. But when we started this, or I didn't start this, when Amy Prieto started this, our founder, 3D batteries were well known, lots of papers about it, but nobody thought you could really actually manufacture one at low cost and high volume. So she started with manufacturing in mind. So she started out with the idea that it's got to be low cost and you have to be able to do it high volume, otherwise why bother? So she took out all the manufacturing processes that are high cost, things like ceramics that are done at thousands of degrees temperature, anything that required a clean room or drying room or anything of that nature, or a vapor vacuum deposition process, took all that out. And she settled on electroplating, water-based electroplating. So that's basically a process that's done at room temperature, atmospheric pressure, out of water, no solvents, hazardous chemicals, or anything of that nature. So it's inherently low cost, and it's well known. People electroplate all over the place. So that meant once she understood that process, or understood that's what I want to use for manufacturing, then she had to invent everything else. So she started with a copper phone, and I'll show you that in a second. But then she had to develop the anode, invented the anode. Then she had to invent the polymer electrolyte, that goes over the top of it, and then the process for putting the cathode down. So she had to invent all that. And if I would have been counseling her at the beginning, I would have said, why would you put boundary conditions around yourself like that? Because there may not be a solution set that works. Why don't you invent the battery first and then come back to manufacturing? But that's turned out to be one of our key advantages. Best way to think about or see our battery, or think about it, is to see this picture. So we start with a copper foam on the left-hand side there. That foam has an incredible amount of surface area within a given footprint, a lot of pore space. The little tendrils are very thin. And what we do then is we put that into an electroplating bath, We electroplate our copper antimony anode on top of that, very, very thin layer. Then we use that as the tool for electrode depositing our polymer on top of that, again, a very thin layer. And then we coat the whole thing with our cathode. So what you have is a lot of anode cathode in that given footprint. So you have high energy density, but the layers are so thin, you get very, very fast charging and very, very high power output. The other thing about our battery is that it's solid state. So typically in a lithium ion battery, you have an electrolyte that's a liquid, and it's a hydrocarbon liquid. And what happens in the batteries, if there's it's cracked or gets oxidized or anything like that, you get thermal runaways and fires. So that's what you see when Teslas crash, or the GM Bolt, when they were having fires with regards to charging. Our battery is solid state. It doesn't have that liquid electrolyte in it, so it's safe. It won't have those fires. Where are we? We have working prototypes. You can see that in the lower left-hand corner. The 3D battery on the top there is the same energy density as the 2D battery. So you can see the footprint's much, much smaller. These are very small batteries, as you can see. We've tested these for all the right conditions. So we have cycle life exceeding 300 cycles to date at 100% discharge. If you do it like a more commercial batteries and treat it, it goes out to thousands of hours or thousands of cycles. We operate down at -30. When I say operate down at -30, I mean start up from a frozen start. So you can freeze this thing at -30 degrees centigrade and still start the battery. It operates all the way up to 120. It's safe. We've cut these batteries in half. They have no smoking. They just continue to operate. And we can charge these things in 3 minutes. So where we are now is to scale this process up and make a much larger battery. We're doing that over the next few months. The other thing that we're looking at is the manufacturing processes. So as I mentioned, electroplating is the manufacturing mechanism of choice. So there's a picture there. Electroplating is done at very high volume at low cost in all sorts of different industries, from semiconductors to aircraft and space. So we need to adopt that kind of technology to our battery specifically. Once we get the anode cathode together in that structure, we then go into typical manufacturing for batteries. So cutting, slitting, calendaring, stacking into a package. So there's a little bit of a difference at the beginning, but the rest of it is traditional lithium ion manufacturing. As I mentioned, we have 28 patents covering 7 distinct patent families over the architecture, the 3D architecture, but also materials for the anode and for the polymer and how we manufacture this. So we were pretty well protected. Our growth plan, as I mentioned, we have partnerships with Stanley Black & Decker and with Hercules Electric Vehicles. Right now, we're in that process of developing the next generation or the next larger battery. So, like I said, where we are today is a prototype that's the size of my little fingernail. Within the next few months, we hope to have a battery the size of my cell phone. At the same time, we're developing the pilot manufacturing design. So that goes in concert with that. And we're looking to develop additional partnerships in the automotive space. And we're looking to build out the pilot plant in the second half of this year, early next year. And the initial commercial volumes would be going initially just power tools, because that's an easier market to get into. And then in the automotive, you can see that we got automotive prototypes going in 23, 24, 25, with commercialization starting at 25, 26. It's an aggressive schedule, we know that, but we are working with the startup that can move just as quickly as we can. I spoke on Tuesday night talking about the advantage of being a small company. We can move quickly, we make decisions quickly, and we can go quickly. And that's one of the reasons Hercules was an attractive partner for us, so they can do the same thing. When you look at the electric vehicle market, it's going to be a massive market. If we go to 100% electric, that's 91 million vehicles being sold in 2019. You think about that battery market, we're talking about $1 trillion market in 2045. I mean, this thing is going to be a massive market. So that's what we're after. We believe we have that battery that addresses all the key issues in lithium-ion batteries today. And we believe if you don't have a battery like this, you're not going to get that transition. Today, the market is really dominated by high-end electric vehicles that have the range that you want, or low-end vehicles that don't have the range that are for very specific markets. there is no mid-range vehicle that meets all the needs of today's consumers. So you're gonna have to have a better battery. And I think the Achilles heel, frankly, is the transportation or the safety issue. As you get more vehicles out there, there'll be more fires. And even though electric vehicles are safer than internal combustion engine vehicles, the perceptions are that they're not. And that could be really devastating to the industry. So we're gonna need this better battery. Commercial plan, we're talking about building relationships now, 2022, 2023, getting prototypes out into the marketplace with these customers, testing, and then initial commercialization 2025, 26. Industrial market, this is a pretty good sized market. You look at power tools. Power tools is going to be $50 billion market by 2030, 2040. Not just power tools, but others as well. So this is a big market as well. You can get into the commercial marketplace here easier than you can in automotive because you can test a lot faster. You can get to that commercial battery much quicker because the batteries are much smaller. So this will be our first market as we go forward. And here's the specific plan as we see it as we go forward. Again, probably commercial products in 2024, late 2023, and that'll be allowing us to get the commercial revenue, start building our capabilities as a commercial company. Because this is such a large market, there is lots of competitors. We are one of the very few people doing 3D batteries. It's unique. We've got our patents on that architecture. There are some people, as the first line here says, doing advanced architectures that claim to be 3D, but really what they're doing is a gradient of the anode, small particle sizes to larger particle sizes. And we think that's interesting, but that's going to be hard to manufacture and hard to get to low cost. The next line is really your solid state guys. And there's a bunch of people out there doing this. Some very large public companies doing solid state. Interestingly, they're still trying to figure out how to manufacture their stuff. So they invented the battery, it works, but now they have to invent the manufacturing process and hope that they can do it at low cost and high volume and low carbon profile. That's the other advantage of ours is it's very low carbon profile. When you're thinking about high temperature ceramics and operating at 2000 degrees centigrade or something of that nature to manufacture, it's not going to be low carbon. And it's probably not going to be low cost. So we think we have an advantage there. And then we have the last group, which is the silicon guys, and they're doing higher energy density, but they're doing nothing with regards to fast charging and making a better battery with regard to that or the safety side. So they're still using liquid electrolytes. They're not solving that problem. So we think we're uniquely positioned. We've been kind of operating underneath the radar screen for a while, but we're going to be having a coming out party this year, and with regards to being an investor conference, what we're really looking at over the next 6 to 12 months is raising another round. We just finished the seed round over the last 6 months. That is total about $9 million. But we're going to be looking for probably $20 to $30 million over the next 3 to 6 months, 6 to 12 months, something of that nature. I'm the CEO. I've been there for 2 years. Amy Prieto, she is the founder of the company, brilliant scientist. She got the Presidential Early Chemistry Award for this technology, and her battery is sitting in the Smithsonian because it's a unique 3D architecture. So brilliant scientist known throughout the battery space. And again, we're excited. We think we have a technology that's going to change the world. With that, I'll end. Thank you very much.
Mike, thank you very much for that. We've hit the time in our program where we're going to hear from a couple of our experts and have a little bit of a panel discussion led by our friends at Haynes and Boone, and have a little bit of a topic of discussion on what the capital markets are looking at in this venture space. Have a little bit of a discussion on what is the trends are, and also hear from a successful energy pioneer who's been through the process that a lot of our pitch companies have been through and successfully been through that. So With that, I will ask Felisa Arthayer, a associate with Haynes Boone, to come up, and we will. She will be joined by Jim Rediger, who is the former president and CEO of Stabilis, and Matt Eastwick, managing director of Javelin Capital. So help me in welcoming these folks, and look forward to the discussion.
Thank you, Aaron, and thank you all for joining us this afternoon to discuss venture capital investment in the energy tech and energy transition spaces. My name is Felisa Arthayer. I'm an attorney at Haynes & Boone, LLP. We are a full-service law firm based in Dallas, Texas. We have offices globally, including in London, Mexico City, and Shanghai. And my practice focuses mainly on mergers and acquisitions and general corporate advising, particularly in the energy, general industrial, and construction spaces. I'm joined today by Matt Eastwick and Jim Rediger. Matt is a managing director at Javelin Capital, which is a specialist investment banking firm headquartered in New York City. At Javelin, Matt focuses on originating transactions and executing transactions across various asset classes in the low carbon economy. He has over 25 years of expertise in the industry, and he's known for innovative financial structures and for building successful businesses. Prior to his tenure at Javelin, Matt was Chief Investment Officer at Clean Capital, where he led around $500 million of investments in distributed renewable energy projects. Previously in his career, he held leadership positions at Credit Suisse, Deutsche Bank, Merrill Lynch, and the Global Environment Fund. As Aaron noted, Jim is an experienced energy transition and financial executive who was most recently CEO of Stabilis Solutions, a company that he co-founded in 2013. During his tenure with Stabilis, Jim grew the company from a startup to a NASDAQ-listed public company with over 200 employees and operations in 3 continents. Prior to these roles, Jim was a senior investment banker at UBS and Credit Suisse, where he provided transaction advice and support to C-level executives and boards of directors. And so we'll kick off our panel today by asking Jim to give us an overview of the life cycle of a startup company and what the capital cycle looks like for those companies.
Sure. Thanks for having me. Is that coming through? Is that good? Not sure. Sorry, I don't see a switch. All right, is that better? Great, thanks everyone for having me. So we founded Stabilis Solutions about 2013. And back then it was just an energy company. It wasn't an energy transition company. We didn't really think too much about that along the way. But we started it in the midst of the shale revolution and US gas prices coming down, and a lot of the producers wanting to use their own excess gas to displace diesel fuel and other things they're using in their operations in the oil field. And there was some intention to reduce emissions, but that wasn't the primary factor. So we were funded by a family office that had operations in oil equipment manufacturing, oil field equipment manufacturing, and used that as leverage to move into some of the primary basins in Texas, most of the Eagle Ford, where we built an LNG production facility, and then some in the Permian Basin as well. So for those not familiar with LNG, it's a liquefied natural gas. The gas comes out of the ground, we liquefy it so we can transport it to off-pipeline applications. Over a series of years, we built a large LNG liquefaction plant in South Texas, and we did that in partnership with Koch Industries and their Flint Hills refining business. So one of our, aside from our family office founding, we used that partnership and the funding that Koch was able to bring to bring that asset to market. Made a series of acquisitions, including one year in Denver, which is how I ended up in the area when we bought Encana's LNG business that they were selling after their transition from dry gas focus to more of an oil-based focus, and then bought a few of our competitors along the way. In 2019, we went public and became NASDAQ listed and grew the business from there. And obviously a few oil price upturns and downturns during that period of time. So, to get to the topic of funding, we started with a family office that had some mutual interest in the sector, moved to a strategic partner who also had some interest in the sector to build out their LNG assets and a larger national network, and then work with some sellers and others along the way to come up with some creative capital to buy assets.
And from your experiences, do you have any do's and don'ts of fundraising to share with our startup company listeners here?
I think the biggest one for me is always looking back is making sure that one of my weaknesses is I assume everyone's aligned on making money, and you learn along the way that everyone's not always aligned with exactly that objective. So making sure you understand the alignment of your investors and your management team and your employees, to me, is the most important one, because that's where you wake up a few years down the line and realize that you've been headed different directions you just didn't quite know it yet. So once you can get that in shape, I think most of the other things can be worked out.
Excellent, thanks, Jim. Matt, turning to you, given your experience in the industry and your perspective, what are some shifting perspectives that you've seen in investors?
Absolutely. First, is this working now? First of all, the question that everyone's been dying to ask, yes, Jim and I did work together at Credit Suisse about 25 years ago. So it was not in the energy economy at all, but we did work together. Good to see you again, buddy. So on the investor side, one of the themes that we're just constantly being reminded of is how traditional investment theses are changing among different categories of the investor classes. And so I'll point out a few, some of which are kind of more longstanding than others, but I think they all point to the trend of a lot of interest in the broader energy economies, energy transitions. Is not just status quo, but more, folks are looking at it as, how is the market going to continue to evolve? Where are the opportunities going to be? One of the things that, again, we're constantly reminded of at Javelin is that things seem to happen very quickly. Change happens very quickly. And investors are taking that perspective and mentality and trying to stay nimble as well to take advantage of the different opportunities that come up. So the first class of investor I'll mention is actually ones that we deal with on a regular basis for a lot of renewable energy transactions, is just broader infrastructure funds. So their mandate is traditionally to invest into assets and to own long-term contracted cash flows out of energy production, solar farms, wind projects, et cetera. But what we're seeing is that these infra funds are now not just 100% asset based, but looking for the corporate investment for a couple of different reasons. One is to actually get access to the assets at a future point in time through investment into a company. So if a developer, for instance, wants to develop some sort of projects and then sell the assets to a third party. An infra fund might come in, invest into that company, and then have an arrangement to basically have a first look at any assets that get developed longer term. So the infra fund is transitioning from not just asset focused to corporate focused as well. And so we're seeing a lot of activity there, and people are kind of cutting their teeth on the ability to do the right type of investment considerations and investment thesis on companies like a lot of the folks that are here at the conference here today. The second one is kind of the good example from our lunchtime speaker, Neighbors, Guillermo, where there are large corporates that have venture arms and looking to invest into companies for a number of different reasons. And so there are groups that are, been around for a few years and also being newly formed that are interesting from a lot of different reasons, for a lot of different perspectives for startup companies and early stage companies to see where the resources and synergies and the potential markets get created through that type of larger corporate investment. So the VC sponsored by large corporations is something that is certainly continuing to grow and build as well. The third one I'll throw out there is something that Jim is familiar with, because he just talked about a couple minutes ago, is the family office. So as we look at family offices and also the trend towards ESG focused investment and impact investment, especially with younger generations of family offices, there is a tremendous amount of activity and interest for investment into the broader energy transition space. So, the very well-known names, the Gates and the Soroses, and those folks are active. The Walton family has got a very active family office, for instance, as well. But then also, the variety of different high net worth individuals or family, private family investment groups are getting more and more into this space as well. And then the last one I'll mention, which is more of a wild card and less defined, is what I just call industry veterans. And so there are a lot of folks that have been involved in these industries as they've grown up and matured. The clean energy economy is not that old on the relative time frame. And so folks that have been doing some sort of business activity in renewables or clean energy, they see a lot and they know a lot, and they take advantage of that because that's not kind of a widespread skill set or experience set. So just as an example, we're working with a group that has been a trader of environmental credits. So more of a brokerage business, ownership and brokerage of the carbon credit markets. And they've, in the last couple of years, launched a VC fund. They're in the market fundraising again right now. And really the reason, the rationale is that they know a lot of these businesses, they've transacted in them. And the information that they've gathered just through market activity is actually quite interesting to LPs, and is in fact some proprietary deal flow and proprietary investment focus. So there's a lot of stuff that's going on. It's been interesting to see how the investor base is continuing to evolve and change. And I guess the advice I give is that there's probably a broader and wider range of potential investors that are out there than there was a couple of years ago, and that will continue to grow and evolve.
Great, thanks for that perspective. And so in your experience with investors and the conversations that you've had recently, what are some technologies that you're seeing investors particularly excited about?
And so picking up on some of the themes that have been mentioned earlier in the conference, one of the things we're focused on as an asset class at Javelin is the broader storage markets. And so the technologies within storage are actually quite interesting in that they've got different advantages for use cases in the storage market. So the EV market and the lithium ion technology seem to work pretty well together. For other more grid-based storage use cases, longer duration technologies are going to come into play. And so what we're seeing now more and more is this, this bifurcation or this separation of the actual technologies and the products, by use case as well. And again, these markets are growing very quickly, but the storage technologies, if there's our specific use cases where it fits well, just because of how the technology works, frankly, that seems to be how a lot of these opportunities are coming into being. So the long duration storage technologies and other storage technologies are something that we see a lot of.
Thanks. And Jim, are you seeing any other technologies that are particularly exciting from your perspective?
Coming at it from a little different perspective, our business at Stabilis has a very big service element to it. And so a lot of our customers on a similar theme are customers that need to be or are forced to be off grid, whether they're in California during difficult times on the grid, whether they're in the Northeast or most recently in Texas when there's some events that are causing issues. There are massive amounts of money that were lost in Texas last year with facilities shut down. So microgrids, either permanent microgrids or temporary microgrids, I see as being a very big theme and one that's going to grow as we continue to make greater and greater demands from the existing grid at no real investment in expanding it and fortifying it. One of the biggest growth markets we saw is in distributed power and the fuel for that power. So I think that'll continue to grow across a number of industries. Some of them are remote, like mines. Some of them are, some of our biggest customers were in, believe it or not, San Antonio and Austin, as they were building out facilities that needed to be fortified. So I think those opportunities are all over the country, and that's going to grow exponentially over the next few years.
Great. And beyond those technologies, are there others that you envision as particularly relevant in the future that either you haven't seen under development today or you think deserve more attention?
Yeah, I mean, as we look at it, we did kind of a market mapping last year, and the general thesis and consensus was that a lot of these technologies, and not all these technologies, are going to work. They're going to be relevant. A couple to mention that we're not particularly focused on because they tend to be, for instance, the one I'll mention is carbon capture. So those are very large transactions. A lot of the large Wall Street bulge bracket banks are focused on the multi-billion-dollar projects that involve carbon capture. There's obviously some that are smaller as well, but the carbon capture technology and the different use cases around what to do with the CO2 enhanced oil recovery is always kind of fascinating to me. That's been part of the approach. But that's carbon capture technology is something that it's quite important for combating climate change, and also it seems to have a lot of potential going forward. So that's other one I'd point out.
And I think, well, it's not the sexiest topic. The backbone of a lot of this is going to be the measurement and control of emissions from the current system, whether it's production or distribution of hydrocarbons. So a lot of technologies out there, ranging from on-site devices to satellites that are measuring methane emissions, and then trying to track that and reduce them. So whether that's measurement, whether that's technology and devices to shore up the systems, ranging from tightening bolts to other types of filters and things, I think are going to be a big deal. The other thing as an offshoot of that, I think we're going to have to evolve to, particularly if there's carbon credit trading that grows, is really trying to have a standard way of measuring and tracking some of these emissions, some of the credits that come with it, so that when companies are saying, hey, I'm reducing my emissions by X, or I'm doing this, there's a standard language, a standard unit of measure to talk about that and to verify that they've actually accomplished that. So I think there's some pretty cool blockchain-based companies out there that are approaching that problem. That'll probably end up meeting in the middle with the companies that are actually doing the measurement on the ground for various kinds of companies that are producing oil and gas, etc.
And so coming out of our pandemic world, what are some impacts that you've seen COVID have on the investment cycle? And are there things that you think we'll take forward that were benefits from that cycle in changing the way that we've done things? and different perspectives that investors or companies might have based on how we've been doing things for the last couple of years?
Yeah, it's an interesting question because, you know, the marketing and the execution of transactions, you know, probably deserves to evolve over time. And, you know, the kind of the roadshow and the investor meetings and sort of spending 3 weeks traveling around the country or the world is, you know, certainly wasn't available the last couple of years, or wasn't the right thing to do. So just in terms of the execution of transactions, a lot more Zoom calls, obviously, and things like that. Still, there's important in-person meetings and conferences like this, you know, can't be replicated, frankly, from my perspective, in terms of getting to know, you know, the counterparties getting to know each other, which is obviously super important. The lawyers are important too, but the counterparties are usually the most important people in the room. But what we see from investor behavior and also from company behavior is that in the stuff that we traffic in, there's so much activity and so many deals, and investors are really a little bit befuddled on how to manage their pipeline and their deal flow, and have really taken the approach of, you know, being as focused or as laser targeted on the specific companies or the specific sectors that they know that there's a greater chance of success, that they'll get a deal done and that they're the most competitive in. So the whatever the list may be, if it's 50, it's down to 10. If it's, you know, was to be 100, it's down to 20 in terms of the targeted transactions. You know, I get asked all the time by investors, you know, what are you working on? What's coming down the pike? Because, you know, investors want to know how and where to spend their time, because again, the number of deals out there is pretty significant, and the wasted opportunity of not being able to get access to a transaction is something that everyone's very focused on. The opportunity cost is quite significant. So in terms of the pandemic, I think there's been a kind of a perfect storm of deal activity and this reduction of actual physical interaction, and investors particularly are just trying to figure out what are the deals I'm going to get done, what I want to focus on. It's not, you know, we'll look at anything. It's, I want to look at these particular, you know, types of transactions, which it's great actually. We don't have to then have, you know, 500 calls or 100 calls. We can have, you know, a couple dozen or a few dozen and kind of get everybody in the right place.
Yeah, the only thing I'd add is from a company perspective, I think having to go offline for a while forced us, and I'm sure a lot of other companies, to get rid of shoeboxes and filing cabinets and kind of all turn into an online data room without really knowing it. So what we found was, coming out of that, we were much more prepared to deal with outside investors, lenders, et cetera, just by the nature of what the pandemic forced us to do.
And are there any other trends or things that you're seeing in the market that you think would be helpful for our audience to consider?
I mean, one of the coolest ones I've seen is we have a mutual friend who's now working in the business of trying to build out electrical lines, so sort of midstream of electrical distribution to hook you know, certain grids into the broader power system. So I think that's pretty interesting. It's clearly a model that's not been developed yet. I think it was tried a few years ago, but when you look at the stress and the capacity that everyone's expecting to put on the grid, and how badly the grid in many places is failing now, I think projects like that are necessary to come from private capital sources and not from utilities and other public sources. So I think that's one that's particularly interesting. You know, a whole different world, but I think we all end up 10 years from now talking about a lot about nuclear and how we adapt that to the various uses we have. But that's ones that probably dealing with a lot more bees in the numbers than we are in this room. So probably not for this conference.
Yeah, just to also just pick up on something I mentioned earlier in the panel, is this kind of ongoing evolution from project finance to corporate finance. And so the infrastructure fund that is an asset owner, a project finance investor, is now becoming a corporate finance investor. And they're very different approaches to the investment world. So project finance is designed to be sort of set it and forget it. You know, all these contracted obligations, you know, don't have to worry about anything. Everything can be non-recourse. It's just an asset that sits there. To the corporate finance, you know, what can we do with this asset? In that case, where there's an optimization opportunity or things like microgrids. You know, if you've got a renewable energy asset or just an interconnect and site control, land ownership or land lease, there's a lot that you can actually do to continue to build out and have better use cases and more revenue opportunities for these different asset classes. So that's kind of interesting to see how folks are evolving from the project finance 1.0 mindset to something that's more of a hybrid, and it's just more of a dynamic situation there.
Excellent. Well, thank you both for your perspectives. It's been really insightful.
So I appreciate that. We're running a couple minutes early, and I've actually got a couple of people that have been emailing questions for these folks. And so that I would ask them, and then if you guys have a couple, we'll, these guys have been gracious enough to do that for us. So the first one has to do with Stabilis. And at what stage did the family office invest in you guys? And how did that process kind of go for you?
I took her, so I think I'm good. Yeah. So that was our initial investor. They had a investment in equipment manufacturing business that was working in cryogenic transportation and vaporization. And so I was working with them on a few other projects, and we saw the demand for this equipment going up, and soon realized a lot of it was intended for LNG, but there wasn't enough LNG production available to meet that demand. And so it was really seeing the market, the equipment they were trying to sell growing, and trying to provide fuel that would accommodate more of their trailer and truck sales. So it was a kind of a strategic investment for them, not just purely financial, which is how we originally got into it.
And Matt, similar type of question, but from the opposite side, from what you guys are seeing, what stage do you guys start getting involved with companies in Javelin?
Yeah, so the easy answer is earlier and earlier. So we've been involved in a lot of corporate raises that are growth capital, companies that are established, but need more growth capital, and then we're going earlier and earlier. And frankly, the time from startup to, in some cases, SPAC it's ridiculous how quick it goes, right? So the timelines are getting compressed, everything's kind of moving quicker. The money can be deployed, more rapidly, and so we're starting earlier and earlier. Not in angel rounds, but starting to look at kind of seed and early stage, Series A type of opportunities.
Are there a couple others from the floor that I didn't cover? All right. Thank you all for your time. I appreciate you being here. Thanks, guys. Thanks.
Well, I don't know if you guys heard it, but I heard it. Jim was the first one today to mention nuclear. And what that means is he has to buy the beer after today for everybody. So thanks, Jim. Appreciate that, throwing that out for us. A couple other observations I'm just going to let you know of, and that is, I don't know if you knew that this was international. We do have two companies from Canada that have taken the trouble to come down here and present to you guys, and thank you for sticking around and making sure that you hear them. And we also have one company from Cleveland, of all places. So thank you guys for coming and presenting here. Certainly we have several companies that aren't from the Colorado area, and we appreciate it. For those of you who are in town, I know we're downstairs. Maybe you haven't looked outside, but for as much snow as we got last night, You will witness kind of the mile high miracle of the sun and how the streets, the sun is a great snowplow here in Colorado, where some of you may be from other places where that doesn't happen. The snow sticks around all day, or all year, I'm sorry, all winter. So we're blessed here in Colorado to have that. So don't worry about getting home. Just go ahead and strap in a few more presentations this afternoon, so you don't have any kind of worry about the streets now because the sun came. Let's see, our next presenter, Colin Bolden. The next two presentations are from faculty here at the Colorado School of Mines. If you've looked at ammonia and H2 combustion, this is an incredible topic. Certainly, if you're in alternative fuels, you hear it quite a bit. Colin Bolden, he's a professor in the Department of Chemical and Biological Engineering. Colin, thank you and welcome.
All right, thank you very much. I really appreciate the opportunity. I want to thank the organizers. I also want to thank the participants in advance for indulging the ideas of an academic here at this meeting. But I'd like to talk here, as he said, about our technology developed with respect to clean combustion using ammonia. So this technology falls into the grand challenge of decarbonization. Of course, principal interest in that is relied on hydrogen, of course, with the $9 billion outlay in the infrastructure bill for hydrogen hubs and hydrogen scale. Of course, the basic idea here is that you take renewable electrons from solar, wind, and convert them into hydrogen, which is relatively straightforward. And then the idea of H2 at scale is that then you use that hydrogen as a hub to service all these other applications. And the real challenge, the unsolved problem with respect to hydrogen is the cost of its storage and distribution, which either requires extreme compression or liquefaction at cryogenic temperatures. And what I'm going to try to convince you of today is that we need to just convert that into ammonia and make that the hub of the clean carbon economy. So first of all, why ammonia? So that plot on your right summarizes the volumetric and gravimetric hydrogen density of basically every compound that's ever been considered for hydrogen storage. And where do you want to be? In the top right-hand corner. And of course, that's where you find ammonia because of its unique properties of being a liquid at room temperature and modest pressure. In fact, there's 40% more hydrogen in ammonia than there is in liquid hydrogen. Okay? And of course, ammonia can then be cracked back into the hydrogen and subsequently combusted. And again, the only byproducts are water and nitrogen. And I think one of the great aspects of ammonia is proven. It's the biggest commodity chemical in the world with about 300 million metric tons being produced. So the knowledge is there to produce it, as well as the infrastructure to distribute it, and that can be all leveraged here. And if you're looking at shipping around energy in terms of CapEx and capacity, ammonia is pretty much one of your best bets. It's much cheaper than electricity or hydrogen. And as you can see there, it's got the highest capacity factor with the exception of oil pipelines, which of course we're trying to get away from. And one of the things I like most about ammonia is it's fuel flexible. So most of the attention to date has been on fuel cells. That's either high temperature solid oxide fuel cells, which can operate on pure ammonia. And then most of the attention has actually been on the far right, where you completely dissociate ammonia and then purify it into 100% hydrogen, of course, to run PEM fuel cells. The reality is, I think these markets are quite limited, and with respect to ammonia-derived hydrogen, I don't think it's going to go into a PEM fuel cell typically just because part per million, levels of ammonia will destroy those devices. So where we think the play is in the middle. One of the great things about ammonia is that it can be partially decomposed and create hydrogen ammonia mixtures. And what's nice about these, if you look at pure ammonia, very difficult to ignite, very low flame speed. On the flip side, you got pure hydrogen, and then you got the Hindenburg. And I'm not trying to make light of it, but it is very difficult and very dangerous to burn, requiring specialized equipment. However, when you tailor these mixtures of hydrogen and ammonia, basically as you change the hydrogen fraction, it's analogous to changing the octane number. And you can basically create designer mixtures that can serve as drop-in replacements for basically any hydrocarbon out there, from fuel oil on the low side up to jet fuel on the high side. And so that's the target market that I want you to think about. Pretty much any place where you burn a hydrocarbon, that's where this technology could be applied. And so how's that normally done? It's typically ammonia is decomposed in what are called packed bed reactors, which is basically a heated tube with a bunch of catalysts. And there's the only equation I'll ever show today. The problem with that is that the hydrogen that's produced inhibits the reaction. So that's why you see in the black line there, the conversion drops very quickly as you increase the ammonia flow rate. And these things have to operate at very high temperature, 600 or so, and low pressure. Now, what we're leveraging here is I have a big program funded by RBE to make ultra high purity hydrogen for use in fuel cells. And so what we do is just simply put a membrane that's permeable to hydrogen on that tube, and we extract it as we produce it. And that's what's shown on the other curves on that graph. Again, by removing that hydrogen, you can basically put over 10 times, we get about 10 times enhancement in throughput at the same level of conversion. But that's, again, there's limitations there. And what we want to do is make these ammonia hydrogen mixtures. And so all we do is add a sweet gas. Typically, you don't do that, of course, if you're trying to produce pure hydrogen. But hey, if we're making ammonia hydrogen, let's use the ammonia as a sweet gas. And this is really good from an economic perspective, because as you see in the normal technology, you process all the ammonia. Now we're just going to process a very small fraction of it, completely decompose it, pull the hydrogen out, and most of it just goes by. So that really helps the capital. Two other benefits of this is that in our current application where we're producing pure hydrogen, we have to rely on a pressure gradient to get that hydrogen out of there. So the hydrogen is collected at low pressure. When we operate with a sweep, that's no longer required. So we can get what I call pressure for free. We can operate these things isobarically at any pressure you want. And a big and not appreciated bonus of this is that we have no nitrogen. So if you look at the conventional technology, you get ammonia, hydrogen, and then some nitrogen. Our membrane separates that nitrogen, so you only have a hydrogen ammonia mixture. And that's big. What I'm showing in this picture here is a conventional gasoline engine, and they just modified it to run on either ammonia hydrogen, what we produce in our CMR, our catalytic membrane reactor technology, or that's shown in blue, or in orange is what you get out of the typical technology, ammonia, hydrogen, and nitrogen. And the presence of that nitrogen really just kills the efficiency. You get about 50% less efficiency with nitrogen around. And if you look at the bottom graph, you also get a ton more NOx. So you get about 3 times more NOx without that nitrogen. And with just running on ammonia hydrogen mixtures, the NOx level is actually less than what you get out of a gasoline engine. So you don't need any special remediation technology. The other thing that's very important, especially for these portable applications, is that we can really easily tune the hydrogen ammonia ratio, which is shown in that graph at the left. Just by simply changing the sweep rate, we can just dial in the hydrogen ammonia mixture to whatever you want. This is really important because, for example, if you want to start that car, you need about 50% hydrogen. And when you're running and cruising down the highway, you need only about 10%. So the ability to, in real time, adjust that is a real big bonus. And then the final big advantage, as I said, pressure for free. So what I'm showing you there is from a recent patent from Mitsubishi, who are trying to green up their turbines by running them on ammonia. And so what they do is they crack it in, again, 600 degrees C at low pressure. But to put it in their turbines, they want to do that at about 50 bar or so. And so that takes interstage cooling, 4 compressors, that highlight area, and there's pretty much nothing more energy intensive and expensive than compressing high gases. And so what we do is completely the opposite. We simply pump a cold liquid to pressure, then vaporize it, which is about 1,000 times less energy intensive. So that's where you get the pressure for free, which is very important for applications like that. All right, so here's our team and our capabilities. Doug Way's expert in membrane technology. He's been my partner in crime on this, and we got a great team of students and postdocs with great expertise in fabricating these reactors. We have this kind of unique ultrasonic plating technique and evaluating their performance. As part of this RBE project, we're building a prototype that we're going to produce over 1 kilogram a day of hydrogen. So that's really forcing us to deal with things like pressure drop and heat transfer that come up when you scale up these technologies. And we also are complemented with a great techno-economic analysis team. John Jakura is a professor of practice here after spending a couple careers at Marathon Oil and Enron. And so that gives us a way to really quantify the energetic and economic benefits with respect to incumbent technologies. And so what is our market business plan? This is very early stage material. And here's, again, the big, there's a ton of markets. Again, anywhere you can burn something, is that generators, boilers, spark ignition engines, turbines, etc. And our first step is really, we need to identify, we do a deep market analysis and try to analyze where are those markets that are probably most suited for early adoption or moving into. And what we have, if you look at technology up there, we have a really good fuel reformer. That obviously needs to be coupled with an application in combustion. So really looking for partners who are interested in doing clean combustion in any of these spaces. Those would be great partners for us to work with. Again, being a very early stage technology, we don't have too much. We got IP protection in place. And I know a lot about ammonia and the technology related to it. I also know a lot of what I don't know, and what I don't know anything about is starting business. So very happy to have the opportunity to be in front of this group, and would love to talk to people interested in advisors and investors, and because it's quite unclear to me, is this a license, a startup? There's very different ways you can imagine this going. And that's what I have for you. I again appreciate your indulgence. I'd be delighted to take any questions you have. And as I tell my students, just focus on ammonia, keep calm. That's a t-shirt if you're wondering. So thank you.
What does your t-shirt say again? I couldn't.
Sorry. Keep calm and focus on ammonia.
Okay. Keep calm and focus on ammonia.
Yep.
So, thank you, Colin, very much. Excellent presentation. Totally intrigued by combustion. So that must be the dinner bell.
Okay.
Thank you. And we are running ahead of schedule. So if you're in queue to present, we have a handful of presenters left. Just make sure you're aware of presentation times are probably sliding up because we're going one right after another. So be cognizant of that. It's a privilege to introduce our next presenter, Dr. Will Fleckenstein. I call him Dr. Will because the last name's long, and he's a professor of petroleum engineering, has other roles here at the university, well-known, long-time member of the faculty here at Colorado School of Mines. Dr. Will is going to be talking about enhanced geothermal systems, which is something that we've heard a couple times now about, but he has some good ideas, some great ideas from an incredible mind. So Dr. Will, thank you.
On timer up here, and they've got one ready for you with a little bit of a bomb or something that goes off if you go over, I think. Wanted to thank you all for coming and giving us this opportunity. I'm a little bit at the other end of the stage from Colin. He's an academic. He's here with a t-shirt. I'm, I think, the only one in the room, except for maybe one or two other people, have a tie. And so I'm glad to see a little bit of diversity there. So my name's Wolf Leckenstein, again, with Colorado School Mines. And today I hope I can kind of knock your socks off with what I call Geotherm Optimal. And what it is renewable energy 24/7. And I think we've caught lightning in the bottle with this. It's the most important project I've ever seen this close. I think offers tremendous economic possibilities. Now, people want renewable energy. And they also want renewable energy 24/7, and they want it cheap. And this is a problem. Now, geothermal energy is virtually untapped around the world, and the reason is because it needs work to work. It has both technically, but most importantly, some economical challenges, and we'll talk about what those are. So when you look around the world, you'll see that hot rocks abound in many places. And so all of those places you see the red, both in the nation and across the world, those are opportunities for geothermal. You got free BTUs that we can use in a power plant without emissions. It's essentially the ultimate zero or low emission power source. The problem is that natural geothermal reservoirs are not common. Think of Old Faithful, the geysers, kind of like the old gushers you thought of the old oil industry. The combination of fractured rock, heat, and water is relatively rare. Now, EGS is going to create an artificial geothermal reservoir by finding hot rock and then creating fractures that are going to allow you to harvest that heat by fracturing that rock. And so what you want to do is to take what's worked in the shale revolution, and this is part of the solution, a big part of it. And you want to go ahead and take those two things, which is horizontal drilling with multi-stage fracturing, and make it work for an enhanced geothermal system, or EGS, where the temperatures are very hot and the fluid injection production rates are also very high. Literally, you're trying to aim for hundreds of thousands of barrels a day in order to make these systems work. This fluid has to be controlled and redirected from the path of least resistance to where the heat remains. And this has been a challenge through all the EGS systems. And all the EGS systems have really kind of failed because of this. Now, in order to solve this problem, we've been awarded a $5 billion performance-based DOE contract for a demonstration project with the Utah Forge Research, which fully funds our development to demonstration, which is important. Key thing is all we have to do is we have to make it work. So here we are looking at the starting point. And the starting point is to take technology that drove the economics of shale development. The horizontal wells that you see here, you see the drilling rates in horizontal drilling for shale have really exploded. And you have tremendous rates of penetration. And now that technology with better PDC bits and optimization of say mechanical specific energy, it's increased the rate of penetration on the latest forged geothermal extended reach well to over 80 foot an hour, where in some places they're actually getting up to 200 foot an hour drilling through granite. There's nothing soft about the granite they were drilling through. It's the technology. And this is really important anytime you're looking at geothermal development, because if you can drill the well costs down, you really start to drill down that capital cost. Now the question is, how do you actually go ahead and use that other tool, which is multi-stage fracturing? So one problem that you have is taking the workhorse of completions for shale development, which is perf and plug. And perf and plug is going to rely upon perforations that have been very effective in shale reservoirs and shale wells. The problem is once you punch a hole in casing, you have it forever. And there is the issue. And that's the problem with geothermal EGS. You see, in an EGS system, you almost think of it like as a water flood, where you have to be able to control the flood and make sure that where you see flood the flood is broken through, it's fingering, and suddenly you're having this colder water that's showing up, you have to be able to shut that off. And that's going to be something I think we can do. You see, what our plan is to build frac sleeves. But these frac sleeves are they're going to be very specialized in the fact that you're also going to be able to use those to be able to have conformance control. And that's a key thing, especially if these frac sleeves are cemented in place, because then you get around the whole problem of packers, and it's much lower cost. You can distribute the thermal forces along the casing, and that makes life a lot easier. So you put these in place, they're cemented, and you can facilitate both stage fracturing with dissolvable balls, but you can also kill thief zones because these sleeves, after all, are linear valves, and you can close them as well as open them. So this is a diagram of what a geothermal optimal system would look like. Now, EGS is relatively simple. You pump cold water into a geothermal reservoir, heat it up, and then you produce this essentially inexhaustible cheap power. However, for every geothermal system, the EGS systems, typically they fail because you suddenly start to have cold water showing up at the producers. And this nice hot water is now about hot enough to make a cup of tea, and that's about all you have. And so what you need to do is to be able to have that ability to create these fractures like you see here, and to be able to take something like a Geotherm Optimal. And in this case, we're going to be cementing frac sleeves in place to create the reservoir in the rock where there is none. And that's a key point. So you want to go ahead and cement these frac sleeves in place. When you look at this drawing, you can see fractures that extend from the injectors to the producers, originating at a frac sleeve. So starting from the toe, a nearly drift diameter ball is dropped, and it travels past all the other sleeves until it reaches the right sleeve, opens it, and fracks quickly and inexpensively. Now, if you're using dissolvable balls, another technology that's been developed in the oil field, the injector is ready for injection almost immediately. So the producers are open hole, then with all of the fracturing done in the injector, and this keeps your costs down. So when cool water starts to break through, a tractor is going to enter the well, move to one of the sleeves, find out which sleeve is actually producing all the water, taking all the water, and close it. And that's going to drive the water to the other parts of the reservoir where now you can harvest that heat. And that's going to be a key difference for what we're going to do. And so the work is done in the injector, and it's cooler there, which means the electronics are going to be able to handle this much better. And you also have a lot less scaling and corrosion. See, the first job I had in the oil field was actually not the oil field. I was working as a roughneck in 1988 on the Salton Sea geothermal wells. I remember learning an awful lot about heat, and also learned a lot about corrosion and scale when you're dealing with 200 or 20% TDSs as far as dissolved solids in geothermal water. So you want to make things simple. So in this case, what we're looking to do is have something cheap to create, cheap to operate, simple, and give you that cheap renewable energy that everybody wants. So why Geotherm Optimal? Innovation in a word. So innovation one, the development of this multi-stage fracturing technology with cemented frac sleeves for EGS environments. Number two, it's the cemented frac sleeves that also can function with tractor control system to detect and remediate that injection short circuiting to be able to inexpensively move that water where you need in order to harvest more heat. So the economic impact of this is to have an economic technology for effective EGS systems. And essentially, you can take this with a universal application anywhere in the world that hot rock actually exists. And that's what I think is very exciting about geothermal. So the market itself is huge. On the left side, you can see the history of geothermal, where you saw a rapid adoption of it, and then it started to tail off a little bit. And you look on the graph to the right, and you can see that the natural reservoirs that are available for geothermal are essentially able to keep production for geothermal essentially where it is. But then you start to see this rapid increase in what they call DBGS. And that's a big increase in the amount of power that could be expected from an EGS system if you have the right technology. And that's what's needed for Geotherm Optimal. There's a huge market out there if we can make this work. Now, Geotherm Optimal's market also has a helping hand. The mandatory renewable standards across the United States, which are giving preferential treatment for renewable energy pricing. 31 states are mandating RPS requirements, and 28, they're just out now mandating renewable power. And the market is growing. So for instance, in California, requests for proposals are out right now looking for 24/7 renewable power, driving the demand for geothermal power to supply this market, because that's about the only renewable that's able to do that. Again, it's a big market opportunity for Geotherm Optimal. So when you look at what Geothermal Optimal is really aiming at as far as within the geothermal market, the first part is the biggest hurdles to EGS adoption is cost. And that's a driver that you have here. The second one is to be able to create fractured reservoirs and take a lot of the exploration issues out of the problem. So basically, you're trying to go for where the heat is, in many ways similar to shale development, where you're trying to go where the hydrocarbons are, and you're trying to bring the wellbore into there, and the same thing you're trying to do with this EGS system. You're trying to go ahead and get the heat where the rock is not fractured in order to harvest it. And that becomes a huge market worldwide if you don't have to rely upon the luck of getting a reservoir that can do this. And again, this is exactly what the shale revolution did for oil and gas. So what's the business model? Well, complete the demonstration of the development demonstration of Geotherm Optimal for EGS at the Ford site in Utah. Something we're fully marketed or fully funded up to this stage. And we're funded all the way through the stage of being able to demonstrate to make sure these are going to work in the extended reach wells at Forge. And then the second would be the demonstration of a full Geotherm Optimal EGS system. Third would be to develop companion EGS technologies. There is a phenomenal amount of technology and research funding that's in the pipeline, and we've got the perfect place to be able to reach out and grab it. And finally, to scale up to provide EGS for RPS mandated and economically driven power. So the team we have, then you see a fair amount of gray hair there. I lead the CSM team. It's tremendously packed with some of the best academics in the world. Hussein Kazmi got in the, I believe, the National Academies of Engineering for his work in dual process systems. Dr. Jennifer Skimmons and Dr. Eustace. And we're the ones that are essentially responsible for the technology development and risk management. Tom Hill leads Tejas RE, one of our team members, and they're going to build the sleeves. It's important for us that we went to find service companies that have built these types of tools that can handle and be qualified for this type of temperature and pressure, because it is tremendous temperatures and pressures to work with. And then finally, George King leads a company called KSWC Engineering Machining, which has been responsible for the development and delivery of the tractor. And he's got precision machining engineering capabilities. And most importantly, he's got a lot of experience. And so it's that experience, I think, that's really critical to help us to deliver these tools so that it really looks like something that can work. And thank you very much. And that is my talk. Appreciate it.
All right, thank you, Dr. Will. Well done. You get an A for the day. Our next presenter, let's see, 1, 2, 3, 4. We have 4 presentations, pitches left, 1 panel. You don't want to miss it. Some of the stuff coming up is really great. Includes material science coming up. Again, we had an earlier presentation from XM Instruments on materials. This is more of a application, which I think is fantastic. Landgate, which is an incredible data platform, and you don't want to miss that. Hydroacoustics, that is a fantastic downhole enhanced oil recovery system that is definitely revolutionary. Corelytics, which I call the blood test of the midstream oil and gas business. So our next presenter, Dan Cohen, he's the CEO of Flight Materials Sciences Corporation. Dan, thank you for coming and thank you for presenting for us.
Always the tech. I joke with people that if this can happen to Bill Gates in the middle of CES at a launch, it can happen to us too. So I have a gift here. For the first one in the audience, without using your phone and Google, to tell me the full name of the author of this quote. God made the bulk, and the surface was invented by the devil. Anybody ever heard that quote before? I really want to give this away today. Not familiar? Okay, we'll come back to that. That was Wolfgang Pauli, one of the people behind quantum sciences. And he's right, because bulk materials are things people trust, but we at Flight believe that a lot of the world's problems initiate with the surface. And that's where I want to focus today's talk. From our point of view, systems failures start and end with surface failures. And rust and ice and fouling are chronic problems that affect critical systems at every scale, in every industry. I don't care where you work, you have this problem. And the solutions exist in abundance, but they often solve one problem and then create another. And the loss, the risk, the damage, and the maintenance costs for these categories of problem remain in the hundreds of billions every year. In 2016, I was working for a small but very dynamic company in solar structures. And I had left behind the world of life sciences ventures, and I was the CTO of this company. We were looking for a way, among other things, to keep ice and snow and frost off of solar panels for more northern installations. Makes perfect sense, right? So I went out to the coatings market, and I didn't find what I was looking for. I found interesting things. We found a coating that is great at keeping ice off surfaces, except it's pitch black, which is not that helpful in the solar realm. We found another one which was great for frost, except we'd have to go out and reapply it on the solar fields every 6 months or so because the rain would erode away. And we found one fantastic coating in a lab, except it would have killed everything in a 10-foot radius around every single panel, which is really not the message you want when you're trying to run a green energy company. But we did find this technology, and it became the birth of Flight Materials Sciences. And what we're doing is introducing radical new methods to treat all industrial materials and prevent these surface failures. And it's based on clean laser techniques instead of toxic chemical coatings. We're unsatisfied with the status quo. Our goal is to take these techniques out of the lab and into commercial utility and industrial scale. And the business model is to prove these technologies and then license them into the manufacturers and into the maintenance groups and the operations folks that you trust, so the power is directly in their hands. So a core technology of this was developed over the course of 30 years, but we're going to condense it into about 30 seconds for you. Ready? This image is stainless steel, just as a sample. And even though it may look polished on the surface, it's really quite rough and random when you magnify. And when coatings are applied, I don't care how you apply them. I don't care what the coating is. Eventually, it's going to fail. The sun's going to break it down. It's going to delaminate. It's going to chip. It's going to crack. Something's going to happen, and it's gone. And when it fails, it scatters the residue to the wind and water, and it leaves the surface of your product vulnerable. The oil and gas sector spends more than $1 trillion on this every year, according to the Aramco Journal. Now, without burning or cutting, we use patented laser techniques that sculpt a new surface texture directly onto your product, onto the material. And this pattern of sharp peaks, it's copied from the lotus leaf, and it's described as super hydrophobic, right? Water repellent. And this one, which looks like penguin heads or mushroom caps, depending on your point of view, is oil repellent. And I use the term oleophobic only at parties to look smarter. Whatever we put on there, it's a pattern with a purpose. So congratulations, you're all experts now in the field of laser surface functionalization, and there are certificates waiting for you at the door. This is what a piece of super hydrophobic metal looks like. We made this in a lab, and with the smallest amount of tilt, sometimes less than 2 degrees, or any vibration or wind pressure, the water is going to bounce off energetically. And if water doesn't stay on the surface, we reduce the hold or the formation of ice. We can slow down or stop the effects of some corrosion, and we can reduce the accumulation of debris and contamination. And there are other benefits in keeping the surface cool or lowering friction. We'll get into each one of those in details. I made this presentation to the Army last year, and after 20 slides talking to the Army about defense applications, one of the captains came up to me and said, "Dan, just put this thing on the screen and shut up. They'll get it, they will." So by modifying the parameters of the laser, according to this patented method, we can design our patterns and copy effects that we see in nature. I can make a texture that repels water on watery fluids or oil fluids. I can make them attract water to the surface and hold there, or oily surfaces. I can make a surface that kills bacteria on contact. I can make one, or spores or viruses. I can make ones that reduce or evacuate heat off the surface or reduce friction. And it's been tested on just about every solid continuous surface there is, on metals, glass, ceramics, polymers, semiconductor materials, for those of you who are interested, and composite materials, even human bone and teeth. Don't ask me why we did it on human bone and teeth. But if you combine any of these green boxes with any of those blue boxes, you get applications that somebody is desperately interested in. We see 2 kinds of fatigue in this industry. We see coating fatigue, which is caused by thermal and chemical breakdowns. And we see pitch fatigue, which is when someone like me comes up here and makes a pitch saying, I have a new coating and it's going to solve all your problems. And you're fed up with all these coatings over the years, saying that with their nanoparticles, their epoxies, they can fix all the problems. And it never really happens. So what I find myself repeating for flight is, we are not a coating. We are just reshaping the topography of the surface of a material you trust. We're not going to make it weaker. We're not going to change its basic properties. You trust Inconel. We're just making it saltwater repellent. You trust high temperature ceramics. We're just making them oil resistant because they can be porous. You trust sapphire glass for your instrumentation. We're just preventing water from beating on the surface. That's what we're not. And there are very few effective coatings for some very complex challenges like helicopter rotors or wind turbines or ocular lenses. So we have opportunities where some of these coatings really don't. And there are very few coatings that cover multiple products in the same area, but we of course can do all of these at once at will. And the customers are already designing new products around this technology. And if the customer already has a great coating, we can improve its adhesion or functionalize the coating in some cases. And we're green. Now, this deserves a moment because people throw around "we're green" a lot. It means a lot of things. We normally ask, as an acid test, can you put it on your breakfast cereal? Of course, this is better defined by what it's not. There's no toxic vapors. There's no water pollution. There's no air pollution. There's no loud noises. There's no harmful radiation or vibration. We can't identify a place where there's harm in the life cycle. And it's our hope that that message gets to our customers' employees and their customers and their investors. And I have a note as an addendum to this slide. I've been asked to say, please do not ask me to put this on your breakfast cereal. Oh, sorry, that one didn't coordinate. So yes, we are safe. We are converting electricity to laser pulses to textures. And that's why we're green. It's a bit of an understatement to say that this has brought us to a wide range of opportunities. In any one day, I'm talking to folks who make submarine parts or dental implants or LiDAR detectors for autonomous vehicles and dairy processors and the Air Force twice a day. Personally, I love it. It's great for professional ADHD. For each of these sectors, we've met with clients who are eager to do better than the status quo in the art of protecting their surfaces and reduce their impact on the environment. Sometimes they're driven by high maintenance costs, or changing industry standards, or tighter environmental regulations, or food or medical safety concerns, or by the promise of some new capabilities. So making an impact on each one of these areas represents a $1 billion opportunity if we have the will to take it there. Now, the idea of nanostructures may seem fragile to you, but we've put these results through some harsh testing, and we're ready to face a lot of the industrial challenges that our customers give us. If you're worried about the treatment, surviving extreme temperature swings, or constant vibration, or ionizing radiation, that just doesn't matter to us at all. And last year, we conducted months of salt spray exposure, pitting corrosion, and other testing sponsored by an oil and gas supermajor, and the test results are very encouraging signals. Our mission and our early adopters in the petrochemical and water industries are interested in preventing corrosion on their pipelines. Does that seem like an understatement? We can improve the longevity of pipes and also prevent scale buildup and reduce the development of toxic biofilms on the inside diameter. The opportunities we're talking about generally are less painting and repainting, less leaks, less energy and chemical used for cleaning, which I know is a maintenance problem, new ways to separate oil and water in process, new ways to remediate and extend the life of existing infrastructure. And of course, this is a very short sample of the oil and gas opportunities that we've seen. And in another time and on another stage, I'll describe the value propositions that we give to solar, which is where I came from wind and from marine and from nuclear energy. Each one of those deserves a 10-minute talk on their own. And we're working on the methods of applying this to materials either in manufacturing or, again, for equipment already in place. Now, as flight approaches year 4 of development, we've brought in some other innovations that complement our work. And so we're involved in demonstration projects for laser-based rust removal and cleaning, which is way better than water jetting or sandblasting. Material rehardening for in situ to keep things in the ground longer, and better ways to weld that don't require chemicals and do a much better job. Most exciting is right here. It's a breakthrough by means of protecting surfaces with diamond. Now, for those situations that absolutely require a barrier protective method for the material, we can produce diamond onto the surface of materials with an improved bond, increased production by 10 to 40 times, and the possibility of open air application. So you don't have to worry about whether your large valve, large pipe, or other large equipment can be put into a vacuum chamber for 5 hours. You can do it outside. All these fall under our theme of photonics-based, chemical-free material improvements that don't just move the needle, they change the game. And that's my quota for exaggerated phrases. Our IP comes from leading institutions around the world, and we have a team to match. Seasoned executives have more than 100 years of international experience in early stage ventures, and we have a very strong advisory board, not to decorate the web pages or to drop names for credibility, but to provide us real assistance as we penetrate into complex industries like semiconductors or aerospace or the defense market. We need the help. Each one of these people has their own language and their own culture. And without these guides, we are lost in that jungle, but it's going very well. We've always run lean. We took our seed round from Techstars in 2019, and we've supported ourselves with grants and revenue from paid customer validation projects. That's how we keep the lights on. But it's time to not be timid anymore. We're graduates of the Centec and Techstars Air Force and other accelerators, so we've already faced down the toughest scrutiny and due diligence that our business and technology could face. And these, unfortunately, can't put names on the screen, are some of our first customer projects. And we've got a pipeline of 155 more asking for trials of this technology. Spending $0 on marketing, we're fielding an average of 1 new Global 1000 client inquiry per week. And we're also seeing the first signals of horizontal growth as our customers explore this technology across their product lines. So we've sold far more than we can deliver, and it's time to build up our capacity, which is why we're raising our Series A. Now, it's a slow sales process and a slow change. It's deep tech, But when we get to the end of the pipeline, it's 5 to 25 years of licensing and royalty revenues per product. So this is my recap. We've collected some exciting new technology for protecting industrial materials with lasers instead of chemical coatings. The time is right. Number two, customers from around the world in industry and defense are banging on the door to try it with some promising early results. Will it fix everything? No, but man, got a lot of potential. And we aim to deliver these results for new products and the built environment in a sustainable and profitable model. And Flight is going to spend every last dollar, every hour, and every ounce of strength fighting these huge challenges and their status quo solutions. Not for a 0.1% piece of some $1 trillion rust fund, but in search of really big victories. So with your support, we'll see this exciting new class of technology emerge and make a world of safer, more resilient everything. I'm Dan Cohen, the founder and CEO, and I invite you to work with us to expand our mission, making everyday materials extraordinary. Thank you. Do I have 20 more seconds? Absolutely. Second crack at the prize, which is a very nice Canadian minted coin. There is a scientific instrument that measures the contact angle of a liquid droplet on a surface. If anybody can tell me what the name of that instrument is, this is yours. You got a hand back there? Goniometer, we have a winner. Please come see me afterwards and collect your prize. Thank you very much.
It's a $100 value Canadian coin, which is US, what, 22 cents? So that's just a little dig. I'm sorry. Sorry. That's bad. I know. Oh, just kidding. Sorry. Let's see. Our next presenter is Landgate, but I haven't seen you on. Did everybody see him? Well, listen, we can definitely be flexible. So John, you see John coming up here to help us out. So let's see, I know I have glasses somewhere around here. Can't read without them. So John, thank you. Come on over.
I can't talk about that.
That's okay. Yeah, they'll go ahead and switch it up. We're going to switch to hydroacoustics back there, Aaron and Michelle.
Oh, good.
Excellent. So they'll be getting that queued up. John Ben is CEO, right?
Chief Development Officer.
Chief Development Officer. I apologize. Chief Development Officer, hydroacoustics. When you think of affordable, and certainly a dynamic change in terms of how you get enhanced oil recovery, he has come up with something. They have come up with something that's ingenious, and so I definitely look forward to listening to that. So, with no further ado.
All right. Where's Mr. Cohen? What a tough act to follow. Man, you could double over as a stand-up. You're great. So I'll do my best. Thank you. It was great to do this. Hope everybody stays awake for the rest of this. And there's a couple other really good presentations to come from here. I got to thinking, listening to some of this morning. I really hope that the folks from TAQ, that we can help slow you down in your business process. And so there's less wells to be plugged out there as we go forward. And the folks with the right water or East Al would love to talk to you, because I think we have something here that might complement that technology that you have. So thanks everybody else for coming. The usual disclaimer and the quick agenda here. Talk a little bit about the background, what this thing is. There's a picture of it right there. It's about 3 feet long. And it's got a couple of moving parts in it. Weighs about 30 pounds. You can run it in almost any well in the U.S. and hopefully overseas with some scaling capability. Talk a little bit about our field tests, operational procedures, current results of what we're doing in the Permian, sort of what we see for the value opportunity here and where we'd like to go next. This is our engineering team. Our company president, Kevin Blackman, is also here today. Thank your hand. So this is just the engineering team, and just to let you know that, a broad base with a very small company. Electrical engineers, acoustical engineers, petroleum engineers. I like to joke we're about a 50-year-old startup, and got started with some acoustic research out of the Harvard's acoustics lab. That technology was sold to General Dynamics. It was a technology that was adopted by the US Navy. We have a device in every Navy submarine. So Tom Smith, I guess it's your brother, I think, was it, that's in the Navy? Yeah, so, and those things are built to last. So what we found is that, that technology and ability of durability, because it lives outside the pressure hull, could we adapt that to something we could do in the oil field using sound technology? Sort of 3 lines of business: energy, environment, and defense. We're 3D seismic, marine-based 3D seismic, our oil recovery tool. One of the technologies we're working on right now is a flow meter that will allow us to measure oil and gas production on an individual well basis at a very reasonable cost. So we're just in the testing phase of that. Be happy to talk to folks about that as well. It's certainly going to be a lot less expensive than Coriolis meters, which is what you have to use today. Let's talk a little bit about the tool system. So what this is it works at a pore space level. It generates a very low frequency seismic pulse that goes through the reservoir, fairly low energy, but it works at the pore throat level. So it doesn't need a lot of energy to generate a pressure drop at the pore throat level to mobilize trapped oil. It pushes that oil away from where the stimulus is taking place towards producers, coalesces trapped oil droplets into larger droplets, and then continues to move that through the producers. The correlation with that, particularly the water floods, is it improves injectivity because it increases the relative permeability of water around your injection wells. And so you get some knock-on effect. Not only do you get better oil production, water floods, you also get better injectivity, so you can move more water through the reservoir. This is based on a practical knowledge that seismic has worked to improve recovery. It's been from earthquakes. People have seen improved production for earthquakes. Talked to someone Tuesday night, said they had a field that every time the trains went by, they saw a jump in production. So people know that this works. It's just, how do you create something that you don't have to rely on natural forces or trains going by? Can you put something in the ground that will give you a continuous seismic pulse, and you can control that and improve your production? It has been approved in Texas as an improved recovery technique, so you get tax credits in Texas for this. There's a paper, this paper that's listed here as goes into a lot of the theory behind it and how it works. I graduated from this school many, many years ago, so I'm still trying to wade through the technology. So I've slept a few nights since I went through petroleum engineering here. There's a great article in Oil and Gas Journal that uses a different, same principle, just a different applied technology. It's a company called Applied Seismic Research. It worked. They demonstrated it worked in both consolidated and unconsolidated reservoirs. The difficulty they had there was reliability. It was a fairly complex mechanical device, and it just didn't last very long. So had good recovery, but pretty complex to run, and it just wouldn't hold up. We're basically something that extends the life of fields at a low cost. It operates independently or in conjunction with existing wells and existing water floods, existing improved recovery techniques. 3 major pieces of this thing: the downhole tool, which I talked about, control panel at the surface. I've got a picture of this here in a little bit. And if necessary, a standalone topside power supply. We typically will work with water floods. We can work with the existing infrastructure. A little bit more about the development history. We started working on this back in probably 2005. And again, it was starting with what can we do with our technology, sound technology, and the durability of our devices that we can translate that into an improved recovery device for oil and gas production. Several patents. We're in about the third or fourth iteration of our tool right now. International patents. The first tests were in upstate New York in 2018. Looked great. Upstate New York, not exactly mainstream oil and gas. So we said we need to go and put this someplace else. So we worked hard to find a company that was willing to take a leap with us and run this in one of their fields. So we ran this thing in West Texas last year, seen about a 30 to 35% increase, improvement in daily oil production from it, and at a relatively low cost. It's simple, it's durable, you'll add to the life of your field. It's not just rate acceleration, it is reserve additions because you're mobilizing trapped oil. Low risk in terms of the actual cost of investment. This is a lot less expensive than drilling a bunch of horizontal wells. And that part, sort of, I think, Dan, you mentioned truly green. We sort of think we're green because you don't have to drill more wells. So, and our carbon footprint is very low. This thing runs like 25 cents a month to run this thing. It runs on a very low voltage and a very low current draw. And you're not having to drill wells to add reserves and add production. So it helps extend the life of existing fields, which is why we just seen the TAQ guys have pulled off a little bit so that we could put some of our devices out there to extend the life of these fields. Field test summary, our early deployments, I mentioned that was in upstate New York, more than double production on these wells, but they were stripper wells. So we took some 2-barrel-a-day wells and turned them to 4-barrel-a-day wells. So on a single well basis, you don't see a lot of improvement. Where you want to put this in is where you've got a fairly high concentration of well bores. Where is it currently? This is currently in West Texas. And this is a picture of the injection well where it's run. You can see a picture of the control panel. There's a lengthy discussion about what we do for operational deployment, the data we collect beforehand, the data collected during, and then our analysis as we go on. This is where it is. We're 20 miles east of Big Spring, Texas. And you can see from that lower picture, we're a little bit north of Interstate 20. So right in the heart of the Permian Basin. It's in a mature water flood. It's a clear fork carbonate formation. It's about 2,500 feet deep. Some of the key takeaways from this is that this thing has been running since May, and 99% of the time it's been up and running. So it's very reliable. We have direct access to it through Wi-Fi. You were here yesterday, I had the thing up and running on the screen so you could see it run, and we can start it and stop it remotely, which is pretty nice. So spend a little bit more time on this. This is the production plot from this field. We had, you can see where the production started to come up. One of the things we struggle with is because this is a real world application, it's hard to have a controlled environment. The operator had about 30 odd wells running up until the early part of 2020. Then they started shutting a bunch of wells in for economic reasons for the most part. So when we saw that increase that you can see in here, which started, it's maybe hard to see it on the graph, but the tool started running about a month before we saw an increase. And so then the operator said, well, we see an increase, let's put some of our other shut-in wells back on production. So we tried to figure out how do we differentiate between what our device has done versus what these wells have done historically. So you can see the gap. So what we did is built a forecast that said, here's what the decline curve would look like if all the wells had stayed on versus here's the current decline, and the difference being the uplift above that purple line is what we get from our device. And that's where we get that 30 to 35% improvement in production overall. Some other ways to look at this for production improvement. The curve on the left, you can see what's happened on the daily oil production on the barrel per day per well basis. So there's a little bit of concern about, well, is this really good? Well, you can see what's happened. The average production per well continued to decline until we ran our device, and now it's come back up. It's not a significant improvement in terms of barrels per day per well, but it's still, when you have 30 some odd wells out there that are impacted by this thing, because it impacts an area that's roughly a mile in radius around the single installation that we have. It starts to be meaningful and again, pretty cost effective. And you can also see from the rate Q plot, you can see that the current production on the rate Q plot is above the historical trend. I mentioned earlier about injectivity improvement, probably focus more, for petroleum engineering grads, we all like to look at Hall plots, but the injectivity plot's probably a little bit more interesting to look at. And you can see, this is the test well, and you can see where that injectivity was about running around 0.3 barrels per day per PSI before we ran the device. Now it's up to about 0.8, so a significant improvement in injectivity. We sort of expected that, because we thought we've seen this, we think this will work. What we didn't expect, which was really good, is seeing improvements in injectivity in other wells. So these are 4 wells that are all within a mile of where we ran the device, and you can see all of those have shown improvements in injectivity. Did want to point out a couple of them, they've had some water issues in the field recently, so they had to shut in a couple of these wells. So that's why some of those data points dropped down. I pointed those out on the charts. I'm running out of time. So hopefully, let's talk about the value here. For upstream producers, we think about the Texas deployment is showing us 30% uplift from the base. We said it was about a 1 mile radius. We scaled that back to say 1,280 acres. Within that 1,280 acres, if you assume 40 acres spacing, you can have a 30 odd wells within that area. The average US production, courtesy of some data we obtained from Enverus through a company we're working with, is about 9 barrels per day per well. So if you think about that, that works on a gross basis, about an 80 barrel a day uplift. Assume royalty, that's about 65 barrels a day with a 20% royalty. What does that mean for the upstream business? An installation cost of about $330,000. We figure these things, we're assuming that we're going to have, so about 25% of the installs will have to be worked over every year after about the 2nd or 3rd year. What that works out to is a capital efficiency of about 5,100 barrels a day. On an operating expense basis of less than 20 cents a barrel for the refit cost for your uplift, and an FD&A of about $3, a little over $3 a barrel. So pretty cost effective when you consider reserve additions that come with it. That number at the bottom, the 221,000 barrels a day, that was based on 1/3 or about 30% of the active US wells responding to this. And so we assume that, if we run this out there in the US and put it everywhere we can, we'd see some of the wells wouldn't do anything, but at least 30% of them would. What about on the business side? So when you think about the business side, if you were the business owner of this thing, what would this look like? So we started out with our business model saying, start out with 20 units this next year, which gets into what we're looking for growth capital, growing to after 5 years, about 2,100 units deployed. Based on what we think, sort of the economic model, that works out to by the end of 5 years, it's about $100 million in annual revenue, which is pretty decent and pretty interesting. So where do we want to go next? We'd like to have it, put it out in some horizontal wells as a test. So that's the experimental part of where we are. On terms of vertical applications and conventional applications, we're past the exploration stage. We're now in the appraisal stage. So we just want to run more of these, and this is why we're looking for some additional growth capital. So we want to get some more of these out, continue to prove that this thing works. We know that it does, but we need to show me the money. You got to have some more of them out there to run some more. There's a whole list there of operating parameters. This touches an awful lot of wells. Anything less than 7,500 feet deep, we can run this today. Optimal temperature of about 100 degrees Celsius. There's an awful lot of fields out there that at that or less, so that'll work. We do need a fair amount of water to go through it. And it needs to be fairly clean in terms of suspended solids and not too much scaling tendencies. So that sort of captures all of it. There's some porosity numbers, permeability numbers. We really want to look for heterogeneous reservoirs. So we're looking for things that aren't homogeneous because we need to get after that trapped well. And what are we looking for in terms of growth capital? $10 to $20 million is what we're targeting for this next year to allow us to build more of these and get them out into the field. So appreciate your time. Sorry to run over again. Took advantage of a little extra time. Thank you very much.
All righty, thank you, John. Be sure to, if enhanced oil recovery, specifically, if you're looking for investments still within the oil and gas segment, that is a great guy to talk to. Hydroacoustics. We were going to go back to Landgate. Johan Hispa, he's the CEO of Landgate. Landgate, Johan, you can clarify, but I think Rice Investment was one of your original funders, and they are a fantastic platform. I'll let him tell you about it, but if you are looking for alternative energy investment, it's a great place. If you're looking for traditional oil and gas investment, it is the Zillow of energy. So incredible platform. Johan, look forward to hearing from you.
Can you guys hear me okay? There's no room to put the drink there, so I'll put it over there. My name is Johan Hispa. I'm the CEO and co-founder of Landgate. Landgate Corporation, as Dan was saying, we are at the intersection of prop tech, climate tech, and again, prop tech, that's real estate type technology, climate tech. We're agnostic too. We're doing minerals, mining, oil and gas, but then we talk revenues also for Landgate. We backed Series A by the Rice Investment Group out of the East Coast. And initially, before we were talking with Dan and Aaron, we were in active search for a Series B partner, and we're actually closing next week with a Series B partner. So thanks all for your support, and we still have some room in the Series B for a co-investor. The lead investor is a very large strategic capital group. I can't disclose the name yet. I can do it one-on-one. I've been authorized to do that if you guys want to have follow-up discussions later. So as Dan was saying, there's money down there. That's much easier. So as Dan was saying, what we provide Landgate, and I'll give some information about the company, where we come from, and how we created Landgate. So we have like decades in the company of energy experience, whether it's oil and gas, solar, or even on the carbon side. And you're going to see what we're doing on the carbon sequestration. Then we've had experience like deploying capital, private equity capital, minerals, land, deploying the capital, and within like a year returning over 3x. Now here's the problem: when we're doing that, whether at operators like Anadarko, at large solar developers, or deploying private equity capital, we had two issues. The first one was running economics on those deals. So you need a team of engineers, scientists, and you spend like a few weeks, at least minimum, to run those economics and to know, is that a good area? Is that a good deal to make an offer on? Second problem, sourcing the deals. So we had an army of landmen, and I don't know if there are landmen in the room, but we were doing that. So we had an army of landmen knocking on people's door, and landowners taking them with a shotgun sometimes. And the conversion rate we had was about 0.3, 0.5%. So you talk to 200 landowners plus, you close on mineral owners, you close on one. So these are two big issues we had. We need to screen those deals fast enough, and we need to source those deals really fast. So the idea was, let's create a zero for land resources, where we bring the landowners. So because the business model we were doing, whether it was energy company or private equity money deployment, was, I compare that to a taxi driver in a neighborhood, knocking on people's door and saying, do you need a ride? And then we came up with a Uber app where the landowners, the real estate agents, come to us because we show them the one thing that they want to look at. So that's what LandGate is about. We have data intelligence, analytics, economic web apps, and we have leads generation. So we talked about the marketplace component. That's the lead generation. We are like all subscription revenues. So 100% subscription revenues. We bring the leads in. We provide the data and analytics and economic tools for the energy developers, for the capital markets, for private equities. So we have users. So Lightsource BP is a user of our tools. We have other big names, Hannon Armstrong, Kimmeridge on the private equity side. And so all those guys are using the leads on the marketplace. What do they want to buy? Like, let's talk renewables. I've heard a lot of guys talking oil and gas, and I've done oil and gas for 10 years. But just to switch gears on the renewable side, so you have companies like Lightsource BP, they are assessing sites and running those super quick engineering feasibility studies in minutes instead of spending $50,000 and months to do those. So you can screen deals much faster. They get the leads coming in from the landowners, raising their hand, willing to have a deal. That's a much different approach. We also have 100% of coverage of solar farms, wind farms in the US. So you have private equities, capital groups wanting to go and buy a very hot commodity right now, renewable royalties. I know there are a lot of oil and gas guys here, so you guys know like mineral royalties, but renewable royalties is going, it's a very hot commodity right now. They all want to buy it. You have a lot of ESG capital going and buying those. So what we do is we have the leads coming in for those renewable royalties. Our subscribers access those leads and they just buy those. So future cash flows on solar farms and wind farms. So we generate leads. And so again, the overview is that's a fine print. Maybe I'll switch to who are the main actors we have and the subscribers. So we have real estate firms. That's our springboard to bring all the landowners. We have over 500 real estate agents who are subscribed, so paying subscriptions, and they access information about the value, the potential value of every land resource on each parcel in the US. That's 170 million parcels, pre-calculated. Dollar per acre value for minerals, like royalties. Dollar per acre per year value for solar, for wind, for carbon sequestration. Every resource on the land, what is the potential value? That's what they want to know. Now, we don't set expectations too high because we've been buyers. We know that doesn't work if you set expectations too high. But we provide enough information so that landowners and real estate agents, they come in, they bring a lot of listings. So right now we have over 45,000 listings. We have over 100 leads a day coming. Those leads, they are, and you guys are going to be laughing, pre-Series B money. We've been spending about $5,000 to $10,000 a month to bring those leads. And we're getting hundreds leads a day. So our Series B is like accelerate, push on the marketing, push on the sales. The other clients we have, as I was saying, is energy developers, energy investors, and capital markets. So very large TAM of subscriptions for those guys. Well, I'll go back to that slide. So what we have is we've completely digitized the economics and the valuations of solar potential for like every parcel in the US, solar potential, solar farm potential, wind farm potential, oil and gas minerals, bottoms up economics. We have all the well data, we have more data than Enverus has. No offense, Enverus. There's the front slide there. So typically the data groups are there, they just have data. Now we have all the interpretation, engineering, we have over 50,000 type curves on the oil and gas side, all forecasted, all automated. We have future drilling locations, everything is there. Now you want to change that, you can change that in the SaaS tools. But if you want quick economics, and if you want to obtain dollar per acre values, you can do that. You can do it for solar. We have solar economic tools. So I'll skip the team. I'll go to the data analytics. So we have transmission lines with max capacities on the solar side. No one out there has max capacities on transmission lines. We have 100% coverage on price nodes. That's 100%, not 65, like other competitors. And then we have completely digitized all the solar farms in the US. Whether you can see them or you cannot see them. If they are under construction or planned, we know the exclusion zones, we know the buildable acreage, we know the capacity, we can calculate where that solar farm is. Why is that important? Because the private equities want to buy the renewable royalties for those guys. So then we can generate the leads for them, or they can go search the leads on our product and extract the ownership information of those landowners. We have all the, what we call like solar land estimates, wind land estimates. That's what the real estate agents and landowners use. And we have the SaaS tools, where what I call like engineering feasibility studies, that normally costs for a solar developer. It takes several months and at least $50,000, 50 to 100 grand. You use that tool, you can do that in minutes. So economics, all in, connected to the data, all of it. And same thing for wind. On the carbon side, full-blown carbon offset reports using reforestation, current forestry, soil carbon offsets, regenerative agriculture. I'm a landowner, I'm a real estate agent. Let's say I have 200 acres. Normally, it's going to cost me $5,000 to get a carbon offset report on my land. It's going to cost me $5,000 to get a stamp from a third party via registry type carbon report stamp on it, third party verification. So it's going to cost me 10 grand to make 1.5 tons per acre per year. So I'm going to make $5,000. So I cannot do that. It's not cost effective. We LandGate, we've automated the carbon offset report, the verification process, and the registry. So registering the carbon offsets on a Vera registry, it's streamlined. So that's a whole new market. We have a lot of interest in carbon offsets at this point. So oil and gas, I know a lot of people don't believe that we've completely digitized the economics. I can tell you that when they say, well, how much do you buy in the Permian right now? And how about over there? I bought something. Well, they've always been like very, very surprised that we're pretty damn close to the deals that close out there. And so you have all the well data, all the directional surveys, production, a proper production allocation using everything, well tests, type curves. So we don't mix like vertical wells, horizontal wells. We know how to allocate the production. And you have full-blown future drilling locations, and you can print your own research reports. Minutes. It really takes you minutes to do that. Now, again, I'll be frank. When we present that, the oil and gas side, to the engineers and geoscientists, they feel very threatened because that's their job. On the renewable energy side, on the carbon side, we're not displacing anyone. They are all consultants. So it's actually a very, very easy discussion. So right now, what I'd say is like, we've been doing oil and gas in the past. We're like 90% of our revenues are renewable and carbon at this point. And so the marketplace side, we talked about it. We present information to the landowners, real estate agents. We're scaling with the real estate agents. We are partner, commercial partner with the Realtors Land Institute, which is part of the National Association of Realtors. They bring in tons of real estate agents specialized in land. Those guys are connected to the landowners, to the mineral owners. They inform them. They bring the listings to the marketplace. We API connect to all the real estate brokers and bring their listings also. So then energy developers have straight access to the contact of the person who's going to make a deal with them. They don't need to have people knocking on doors. It's much, much easier. So we've had an exponential growth, and I'll skip that. I think you know we can talk like I can talk more one-on-one, but like some projections of financials for 2022, 2023, 2024. But we really pumped. We have a very large, very strategic Series B investor that's going to push our revenues big time. It's going to help us grow our sales team, marketing. We've had one sales guy for the past 2 years, only developers all that time. And now we're going to push and grab market share and look forward to talking with you guys.
Now, I'd like to introduce our next speaker before our panel conclusion, our panel discussion to conclude the day. There's been talk today about corrosion and obviously its impact on oil and gas pipelines. So it's very timely to have Corelytics here presenting. Anwar Sadek, their CEO, is here. He came all the way from Cleveland. So congratulations on seeing some sunshine over the winter. And what Corelytics does is they solve microbiologically influenced corrosion problems for oil and gas pipelines. So with that, I'll turn it over.
Thank you, David.
Well, first of all, a bit of compassion. This is the very first time I'm presenting in person since the start of the pandemic. So it finally feels good to be able to kind of what we used to know as normal again. On that note, thanks to EnerCom and the Colorado School of Mines for making this event very amazing and exciting. Thank you. As Tim said, my name is Anwar Sadek, and I'm the CEO and co-founder for Corelytics. We are developing a smart test kit for detecting and monitoring microbial corrosion, which is created for the oil and gas pipelines. Did you know there are microbes growing in all of 2.8 million miles of pipelines in the United States? And these microbes are the major culprit in causing pipeline corrosion, and that is leading to pipeline failures, which is not only costing the oil and gas industry billions of dollars, but that also affects our everyday life, such as increase in oil and gas prices for our home and transportation. And above all, pipeline failure is causing really harmful effect to the environment. Well, we all know oil and gas is not known for being environment friendly, but we are about to change that. So what is the problem? Why can't the oil and gas industry solve this corrosion problem? Current monitoring method makes it very difficult to know when microbes are growing inside pipelines and if they're really causing corrosion. So failing to adopt timely and effective mitigating strategy is leading to catastrophic failure, which where the oil and gas is fined by DOT heavily. So, well, oil and gas, we all know it's a very old industry and there has not been much changes. So the reason for not being able to have effective mitigating strategy is because their testing method is pretty old, and that needs to change for proper integrity of the pipeline. So let me walk you through what corrosion engineer or asset integrity managers, how they deal with microbial corrosion problem now. First, they use these test kits called bug bottles, where they see the result by color changes. And it's telling them if there are microbes present. But we know from research that presence of microbes does not mean they're really causing corrosion. Above all, this test provides a lot of false negatives and false positives. Next, they leave these metal coupons using probes inside the pipelines, and they leave these coupons anywhere from 3 months up to a year. And above all, these probes are very difficult in installing and uninstalling to retrieve the coupons. And one of the biggest problems we receive from our customers is that they don't like these probes because this is so hard to install and uninstall that they are another primary reason for leaks and failures. Next, they send this coupon along with fluid samples to the lab where they do extensive research and they send back huge reports, which is very difficult for operators and chemical engineers to understand. And above all, it takes such a long time that this report becomes almost outdated. During this waiting period time for this report, the environment inside the pipelines changed so much and the corrosion propagated to a level where it can no longer be mitigated without downtime to the asset. So based on guesswork and outdated data, they are unnecessarily dumping $1 million worth of chemicals and biocides. Next, what do they do? They repeat this entire process all over again. They're stuck in this vicious cycle of guesswork. That is why corrosion engineers and asset integrity managers are having sleepless nights out of pipeline failures. Well, to fill this gap of guesswork, we introduce you Corrolytics MIC test kit. And this is the first test kit based on electrochemical technology. Well, those who you don't know, corrosion itself is an electrochemical process. And in order to detect that accurately, you need an electrochemical technology. That is why we are the first of its kind in the market to be able to detect and differentiate between microbial corrosion and other types of corrosion. And this provides data on site and accurate information such as microbial activity and corrosion rates. Corrosion rate is a parameter which is very important for corrosion engineers. That is how they determine the proper mitigative process they need to take. And above all, they're going to get this valuable data, which is backed up by our integrated AI technology software to receive this valuable data. And we have a full patent pending. Although the patent was filed by University of Akron, we have the full exclusivity rights on it, as we're the inventors of it. So what is the customer ROI on this? Using our correlative technology, right now, they can be able to prevent unnecessary chemical treatment and biocide use, which will save them up to $1 million per year. And top of that, they will be able to reduce unnecessary monitoring cost by 50%. Well, above all, they will be able to avoid any catastrophic failure, which leads them to a bad PR and then a bunch of litigations. On top of that, fines by federal and state agencies. That's why our technology stands at a critical, important technology they need to use in order to maintain the integrity of the pipeline. Well, don't just take our words for it. From our 300 plus customer discovery interviews, our customers again and again showed the interest and the need for this technology, where BP actually told us that this is a must-have technology. And another person said that to be able to differentiate between microbial corrosion and other corrosion is pretty much answering $1 million question. Well, what does the market look like for this? Global demand in microbial corrosion monitoring and mitigation is about $9 billion per year. That gives us our total available market. And this microbial corrosion is primarily seen in the upstream and midstream of the sector. So that serves us a served available market of $3.89 billion. And from our interviews, 80% of our customers said that this is a must-have technology, which gives us about $3.1 billion as our target market. Well, this is our go-to-market sales and marketing strategy. Currently, we are partnering with Hillcorp Alaska, and they are providing us their oil and gas samples even before we develop this kit. So since they know we have this technology in the lab tested, so they are sending us their samples to get valuable data, as if they wanted this information like yesterday. And DNVTL, who is a very primary corrosion consultant in the field, they had been our industrial partner since the development of this technology. And we are also in the process of partnering with Occidental Oil and Gas Corporation to get their oil and gas samples tested. And we're going to leverage our existing relationships with over 300 plus customer discovery contacts so that we can take their oil and gas pipelines inside our lab and do testing for them to provide them valuable information where they can take care of their pipelines safely and accurately. And I'm sure a lot of you know about the AMPP, formerly known as NACE, which is the biggest corrosion event for the oil and gas industry. That is where majority of the transactions, the technology, everything happens there. So we will be presenting there as well. And we are going to also release advertisement in corrosion magazines, and we're going to publish case studies and journals, and we're going to also do massive email campaigns to market our product. Well, this is our go-to-market growth projection. This seems a bit of a little bit fun to read from there, but I'll try to make it as easy as possible for you guys. So currently, we have the technology in the lab where we are able to give them information such as when microbes are growing and if that is really causing corrosion. We can also provide them data such as corrosion rates, pitting information, which they can use to take proper mitigative stage. Right now, we are also producing 10 to 20 designs in the lab, which we'll be testing out along with our laboratory design so that that will lead up to making our MVP, which will be released by Q2 of 2023. And at that time, we will be testing in the field with our strategic alliances such as DNVTL, Hillcorp, and Occidental. After that, we will have a limited launch of about 1,000 units that gives us a projected revenue of about $1.4 million. After getting customer feedback and reiteration and advancing our technology a little better from their feedback, we are ready to go to market by end of Q1 of 2025, where we will have a full launch of our MIC kit. And that will give us a project revenue of about $2.6 billion. And from our projections, we found out that by 2026, we will have a projected revenue of about $9 million. Well, this is our pricing model. This is based on our customer findings that they spent anywhere about $250,000 per year for monitoring technology. And we are selling the MIC kit as a consumable, the electronics unit and the software license with one-time buy. It might be a little confusing how I said it. It's pretty much like, I don't know if you guys are familiar with, how you do the blood sugar level test. You buy the electronics and you buy that one time, but you keep on buying the strips to test the blood level. This is the same idea as what we're going to do. The kit would be consumables, electronics, and license would be one-time buy. And here's our competitive advantage. There are a lot of kits out there, which actually tells them if there are microbes growing. Like I said before, growth of microbe does not really mean it is causing corrosion. And they cannot be able to provide if the microbes growing is leading to corrosion. So that is why our technology is able to provide the microbial corrosion rate. That is why it's important for them to take proper mitigative stage. And there is no technology in the market right now that can tell them when microbes are growing and if they're really causing corrosion. And apart from that, there's only probably one company out there who can actually evaluate if the biocide they're using, if it's working or not. But once again, they only detect microbes. They don't tell if it's causing corrosion. That is why we are the only one in the market which is able to detect corrosion and microbial corrosion and also let them know if their mitigation strategy is working or not. Well, we do have a very strong support tech and innovation partners in Ohio. For example, we are working with SCORE, Magnet, and Jumpstart for various entrepreneurial service providers. They are guiding us how to take this amazing technology to the market. Well, for our achievements, we have completed the NSF I-Core program, and from that, we were able to do 300 plus customer discovery, and we were also awarded the team award from that NSF I-Core program. We were able to secure successfully the National Science Foundation SBIR Phase 1 award, and recently we were also awarded Tech Connect Innovation Award for the year of 2021. Recently, we also won the Magnet Inspire pitch competition, which allowed us to win $10,000, but that's not the main value. They are providing us engineering service so that we can make our in-lab technology into a more producible for mass production, easy to produce design. And here's our amazing team. We are experts in electrochemistry, microorganisms, and business development. For example, myself, I just recently finished my PhD defense. That technically makes me an expert in the field. And my coworker, CTO of Corolitics, is sitting right there. She's also an expert in microbiology, corrosion, and electrochemistry. Dr. Shalsi Monti-Bromer, she has extensive experience in electrochemistry. She's our scientific advisor. On top of that, she comes with a lot of entrepreneurial expertise as she has her own startup. Dr. John M. Sanko, he is an expert on microbiology. He is our advisor and consultant for that field. Jim and John are very expert business development individuals in the field. For example, John, he had been working 30 years plus in the oil and gas industry, and this makes an amazing team to take this technology to the market. I haven't included any pictures of our interns. We have at least 5 interns working for us right now, helping us to develop this technology into a field test ready. So what we are asking is $500,000, which I am sure is not a lot of money for a lot of these VC investors here, but we do provide an attractive opportunity to make money. What we want to do is we want to take this lab technology and make it MVP with the software and the electronics, which we will be ready to test for the field test. And by that time, we will be also ready to sign contracts from our strategic partners. And once again, my name is Anwar Sadek, and if you want to reach out and talk to us about it, we are right over there after the conference. We can also get together, talk about if you want to keep your pipeline safe, talk to us. If you want to make a lot of money, also talk to us. Once again, thank you.
That was great, thank you. We will get the mics out here, make sure they're charged up, and we can all hear it. We'll make sure we're holding them close to our face. But we have a really exciting panel here to close out this day that I think has been tremendous. We've had a fruitful conversation and speaking with a lot of our presenting companies. I know they've had positive conversations with capital and industry. And so, I think that's a wonderful achievement for this event. That was our goal, is to put good ideas and capital together, and in partnership with Colorado School of Mines, really excited to do that. Not ready to close out the day yet. We are welcoming our friends from Bloomberg and BNEF to host a timely and topical discussion in and around Energy 2.0 and carbon capture in that space. So folks that know Bloomberg certainly know the terminals, but should know that they're much more than that. And they have a tremendous resource in their BNEF team with analysts. One of those is Matt Bravante. He's going to lead our discussion here and an expert in this space. And we're joined by Wolf Carbon Solutions and Chemvita Factory. I'm sure you're going to get a little bit more, but I'll turn the stage over to you guys. Thank you for being here.
Perfect. Thank you. Can everybody hear me okay? So hello, everyone. As you said, my name is Matthew Bravante. I'm a research analyst at Bloomberg NEF in the industrial decarbonization practice. Bloomberg NEF is a research firm within the larger Bloomberg LP company. And we really help folks in the energy community navigate the transition to a lower carbon economy. A couple decades ago, we were a startup ourselves, and we were looking primarily at clean power, so wind and solar, looking at costs and market development. And as the transition to a lower carbon economy kind of moved past clean power, so did we. We started looking at things like electric vehicles and clean fuels. And what became pretty immediately apparent to us throughout the journey was you can decarbonize the power sector and you can electrify new sectors. But in order to really push emissions to zero, you're going to need some sort of low carbon or clean molecule. Clean electricity just isn't going to get you all the way there. So when considering this clean molecule challenge, today we're going to talk about a handful of solutions, namely hydrogen and carbon capture and storage. So with me on the panel today, I've got representatives from companies on the forefront of this battle, looking both at hydrogen and CCUS. So all the way across from me, we have Marnie Reeks, who's the head of biomining at Chemvita Factory. Chemvita Factory is a biotechnology startup working in the industrial decarbonization space. They actually have a pretty exciting announcement today that I'm going to let Marnie share with you in a bit, but you guys are in for quite a treat. And then immediately next to me on the right, we have Nick Knoppinger, who is leading the US effort for Wolf Carbon Solutions. Wolf Carbon Solutions is an offshoot of Wolf Midstream that focuses on the transportation and storage of CO2. They're really an industry leader and have some of the biggest projects in the world going on right now. So needless to say, we're in pretty good hands with these two. But before I hand it over to them, I just want to set the stage for this conversation around scaling hydrogen and carbon capture and storage. On the face of it, they're pretty different technologies. One, in carbon capture, is largely aiming to extend the use of fossil fuels in industry. And the other, hydrogen, is largely aiming to replace the use of fossil fuels in industry. So seemingly pretty different, but the moment that these two technologies are in is very similar. For starters, neither sector is unfamiliar with the hype cycle. Over the past couple decades, especially here in the States, there have been large booms and busts in both the hydrogen and CCS industries in the eyes of the energy industry and in policymakers. Both industries are experiencing quite a bit of growth at the moment. My firm, Bloomberg NEF, tracks hydrogen projects and CCUS projects around the world. On the hydrogen side of things, we saw the market double from 2020 to 2021, and we expect the market to quadruple in 2022. On the CCS side of things, we're at about 40 million tons per year in terms of carbon capture capacity. We expect that to be somewhere around 190 million tons by 2030. So, quite a bit of growth in this industry. And the last similarity I'd like to point out is that both industries have found friends in Washington, D.C. In the recently passed infrastructure bill, both industries got $20 billion, mainly for demonstration projects. And that was about a quarter of the total money allocated to energy technology solutions in the bill. So quite a bit of money as it compares to other technology solutions. So we're in a pretty interesting moment. There's a lot of potential, but there's also a lot of uncertainty. It's pretty clear that we need these technologies or some technologies similar to these technologies to reach net zero emissions. So with that, I'm going to hand it over to both of you. I'd like you to just, introduce yourself, introduce your company, and talk about how you're innovating or working in these markets to help bring these technologies to scale. Maybe I'll start with you, Nick.
Sure. Okay. My name is Nick Nalkinger. I'm head of Wolf Carbon Solutions US. As you mentioned, we started off as kind of a spinoff of Wolf Midstream, which is a $4 billion energy infrastructure company based in Calgary, and it's backed by CPP Investments, which is the largest pension fund in Canada with $500 billion of assets under management. Wolf Midstream, the reason we got into this business in the US is because of a specific asset in the Wolf Midstream portfolio called Alberta Carbon Trunk Line. It's a 150-mile line that captures CO2 from a fertilizer plant and a refinery and sends it down to an oil field for EOR. It is to date the only pure third-party anthropogenic CO2 system in North America. And so we've been running for that system has been running for about 2 years, captured about 2.5 million tons. And CPP got a lot of confidence around the technology and the risk profile. And they looked south of the border and saw multiples of opportunity in terms of carbon capture and sequestration. So we established Wolf Carbon Solutions US last year. It's a separate company. It's affiliated with Wolf Midstream, but it's separately owned and operated. We're backed by CPP Investments as well. Our mandate at Wolf Carbon Solutions US is to deploy capital into large energy transition infrastructure projects across the lower 48. Because we're kind of an infrastructure backing, we prefer large capital deployment with proven or lower risk technology. So what does that mean? That's, carbon capture is obviously proven, very safe technology. Blue hydrogen, very established technology, been around for decades. And then sustainable aviation fuels is something that we're also looking at with a keen eye and seeing kind of which of those technologies make sense and is worth investing in. But the first project that we dipped our toes in was a carbon capture and sequestration system in the Midwest. We were pursuing the Midwest for the past year, largely because under the current 45Q structure, which will be $50 a ton starting in a couple of years, the most economic sources of carbon capture are pure CO2 from ethanol and fertilizer plants. So where you're going to find that, you're going to find a lot of that in the Midwest. And so we started targeting various emitters in that area. we wanted to find someone who was had a lot of scale and also was investment grade. And so, there are a couple of guys out there, and ADM was they liked our profile, they liked our investment mandate, and we partnered up late last year and announced it about a month ago. We don't have a name for this system yet. We're just calling it the Midwest system, but what it is it's 350 miles of 20-inch pipe trunk line extending from sequestration zones in the Mount Simon Formation, which is underneath the Illinois Basin, extending north and then west to two ethanol facilities that ADM operates in Cedar Rapids and Clinton. In addition to capturing their process gas or the process CO2 gas, we're also looking at retrofitting their coal plants that power the plants. And we're looking at blue hydrogen, we're looking at just oxy-combustion, and basically capturing the CO2 from that process so that the whole supply chain for ADM is zero carbon. It's a third-party system. It's sized for 12 million tons a year. ADM, and this is public knowledge, ADM from the ethanol side will provide 2 million tons a year of volume. So we're oversizing this significantly. And we're doing that intentionally because CPP is a long-term investor. They're a life of asset investor. So when we build things, we look at a 20 to 30 year horizon. And we have a pretty high conviction that over the next 10, 20, 30 years, all types of industries are going to look to decarbonize. And so where we are on the eastern side of the Midwest, in Illinois and Iowa, and then when we look north, we look east into the Ohio River Valley, there are a ton of industrial facilities, refineries, hydrogen plants, petchem facilities, steel mills, cement, you name it. And we want to size our trunk line to be ready to, capture and send those volumes into our system. So we are early stage development right now. This is a very, CCUS is a kind of a rather complicated project development structure compared to my background, which is oil and gas midstream. There's a lot more permitting involved, a lot more scrutiny at various agencies. And it just takes a little bit longer. So we envision being in operation in middle of 2025. We're actually talking to customers above and beyond ADM to continue filling up that space.
Awesome. Yeah, that's just massive. I mean,
yeah,
you can't understate how big that pipeline is, but hand over to Marty.
Oh, thanks, Nicholas. Hi, everyone. I'm Marnie Riggs. I'm a chemical engineer from New Zealand. That's the strange accent. And yeah, I've spent the last 25 years in the mining industry working for global mining companies, BHP and Rio Tinto, in doing all sorts of things in all over the world. But I'm here today as part of the leadership team at Cembeta Factory. And Cembeta Factory is a synthetic biology and biotech platform startup company. So we're a Series A startup, and we're backed by a number of oil and gas mining companies and sort of conglomerate companies that span both oil and gas and mining. So yeah, we are focused on biotech solutions solely for heavy industry, so oil and gas, mining, and aerospace. So we're as the sort of the genomic revolution that's brought us, huge big step changes in pharma and agriculture and even in the food that we eat. That's kind of bypassed the heavy industry a little bit. So Cembeta aims to bring the latest in biotech and synthetic biology, so bioengineering, to those industries. We have three main sort of verticals and products that we look after. So the first one is on CO2 utilization, so the U in CCUS, where we convert CO2 microbially to useful biomolecules. And our flagship project there is with Occidental Petroleum, where we're producing a bioethylene, so a carbon negative bioethylene. Our second vertical is biomining, which I lead up, and we have an office here in Denver. And we're bringing what the mining industry is used to using in terms of biotech. The mining industry does bioleaching, and that's been around since the 1980s. There's not a lot of science put to that, so we're really bringing the latest in science to improve bioleaching, where it's done for sort of copper and gold and things like that, but also extending that to some of the new commodities like lithium or cobalt, where bioleaching is not done, and also then extending it throughout the mining industry. Our third vertical is subsurface biomanufacturing, which is probably the most interesting to the group of folks here. This is where we're actually microbially manufacturing chemicals in oil and gas wells. And as Matt said, we've got a big announcement that came out today. It's the launch of our gold hydrogen product. So this is where we're taking spent or abandoned oil and gas wells and microbially producing hydrogen from the subsurface wells. So this essentially can give you carbon neutral hydrogen. Our initial costs, initial economics suggest that we can do it at $1 a kilogram of hydrogen. So it's looking like it's going to come in very cheap. And what it does is it's really capitalizing on, you know, all the infrastructure that was put during your for oil and gas extraction and extending the life of those wells. We're launching that today as a joint industry project. Our founding sort of industry member from that is Charter Industries. Our project management firm, our engineering consultancy firm, EXP. And today we're launching this product and inviting new companies to join us on this 3-year journey to pilot and look towards commercialization of gold hydrogen. Thanks for having me here today.
Sweet, well, you've heard it here first. Gold hydrogen, we've got a new company. Marty, I want to stick with you just and dive a little bit deeper there. So you've announced this new product and you've announced this kind of 3-year pipeline. Would you just go a little bit more in detail in terms of how the process is actually going to work in the field? You know, I know there's a couple different combinations of the ways you can do it, whether you're pulling up, you know, CO2 and hydrogen, pumping it back down, maybe using a filter to keep, you know, certain gases below ground. So just like tell folks a bit more about how it works and, you know, kind of how you see this next 3 years progressing the project.
Yeah, no, sure. So sort of our ideal abandoned well would be a homogeneous sandstone well where you have your, you know, your injection pipeline sort of near or below the oil-water interface. And what we're going to do is enhance that community microbially down there to increase the production of hydrogen. CO2 does come out with that as well. So we've got a couple of ways of how we can deal with the CO2 that comes out too. We can sequester it straight back down. So that's one option, and that's the option that gives you the dollar per kilogram of hydrogen. Another option that we will be looking at throughout the 3 years is, you know, another microbial process subsurface to re-sequester that CO2 before it gets to the surface. That will actually lower the cost of the hydrogen even more, down to about 0.8 of the dollar. Because most of the cost of this technology will be the capture of any CO2 that comes off and the sequestration of it again. At the moment, we're probably at about a TRL 2, so we are in the lab, and over the next 3 years, we want to bring that to a TRL 7. So we're really looking for partners who have got, you know, suitable abandoned wells where we can, you know, I guess, conduct test work in the lab, scale up on your particular oil wells, and then potentially also move into a field pilot as well.
Thanks. I want to come back to and talk a little bit more about you know, the project specifically that you're doing in the Midwest. I know, you know, you've announced that partnership with ADM, and you're focused, you know, at least in the early days, on ethanol. That's, you know, the lowest cost capture, but you've got a lot more pipeline to fill, right? So I just want you to talk a bit more about, you know, your vision long-term for adding folks to that pipeline, and how hard it's going to be, or easy it's going to be, to kind of scale up the carbon capture cost curve and get some of those heavier industry folks like the steel mills and folks like that on board. Like, any conversations you've been having, you know, any kind of plans to that measure?
Sure. So we chose the eastern side of the Midwest for several reasons, but one in particular was the fact that it had the best capital efficiency of any kind of ethanol-based, you know, CCUS system out there. And what I mean by that is when you're pegged at $50 a ton before your revenue is capped, you really have to be extra efficient on capital deployment. And so you have to look at concentration of volumes. You have to look at proximity of volumes to the sequestration area. And so ADM has 2 massive ethanol facilities that are, you know, within a couple hundred miles of the core area of the Mount Simon Formation. So that helps us maximize our returns and give more of the economic pie back to our customers. The other reason for the Eastern Midwest is that we're in closer proximity to as you mentioned, some of these industrial centers like Chicago and the metro area, St. Louis, and most importantly, the Ohio River Valley, Indiana, and Ohio. And so we are, as we look out, as far as a 10-year plan, 20-year plan, we're probably going to be building laterals north to some refineries and and we're already talking to these people. We are interested in building east, 200, 300 miles all the way to eastern Ohio. There are a lot of industrial facilities along that pathway, including there's a lot of ethanol as well. But you have to be smart about it. The pipeline is incredibly expensive because it has to be thick steel. The reason for that is the CO2 gets compressed up to a dense phase liquid at 2100 psi. And so you can't have any cracks in the pipelines under such a pressure that you have to have steel that is 2 to 3 times the thickness of a gas line or an oil line. So that means a ton of extra cost per mile to, as far as the actual steel, as well as the logistics of installing it. It's so much heavier. So we think it's about $2 million a mile, kind of $120,000 to $150,000 per inch mile. So when you go out and step out, from kind of your core area, every mile is going to be eating into your economics, given that you're capped at $50 a ton. So that's the struggle that we have in terms of looking at growth above and beyond ethanol and fertilizer in our core area. But I think that we do see a line of sight towards a higher 45Q structure. It's not going to be part of the Build Back Better bill, but my guess is that it'll be passed probably end of this year, early next year. My rationale for that is that I don't think, so we have midterm elections coming up in November, and I think that Republicans are going to do everything they can to not give Democrats a win. And but when those elections happen, whoever takes takes, the 45Q has bipartisan support. So once elections happen, I think that's going to be the first thing on the agenda is getting climate legislation passed. So once you get into $85 a ton territory, in addition to some technology improvements that we're seeing, some incredible technology improvements that we're seeing on the capture side to drive down costs from for steel and refineries, driving it down from like $80 a ton to $40 a ton. Suddenly, you're looking at a massive increase in the market share. Almost everything is in play. We're also talking to power plants. There are a ton of coal and gas power plants in the eastern Midwest and the Ohio River Valley. And they want to survive for the next 10, 20, 30 years. They have running room to still, they have a lot of life in them. And so a lot of these companies are looking at decarbonization. It just costs a lot for a power plant. It's probably around $100 a ton to capture and sequester, not to mention if you have to pipe that CO2, 50 or 100 miles. So there's some DOE funding that's going on. There's some other angles that these companies are pursuing, but there's a lot of interest from the power gen side. And actually ADM, as I mentioned before, is already looking into that because they're very advanced in their zero carbon policy, and they're trying to make that happen.
Wonderful. So you kind of alluded it to there. I want to talk a little bit about policy with both of you. So as I said earlier, the infrastructure bill at $20 billion, most of that's going to go to large scale demonstration projects. The Build Back Better bill had tax credits, both extending and raising 45Q, and also a first of a kind tax credit for production of hydrogen. So I know you talked about 45Q a little bit, but I'd love to hear from you your thinking around the infrastructure dollars, and then maybe Margie, both the infrastructure dollars and also what that tax credit would mean in terms of getting interest for your product and making the economics extremely attractive.
Sure, I'll start off. I mean, this is a very capital intensive industry. CCUS is very capital intensive. Even if your emissions are close to sequestration, the amount of horsepower and compression and dehy they have to put in to get the CO2 into that dense phase state, and then developing the sequestration and all the dollars that go into the Class 6 permit are enormous. And so it's going to require a lot of infrastructure dollars, a lot of capital. We are not relying on government funding outside of obviously 45Q. We're not relying on grants or low interest loans. We're trying to make this work from a private standpoint. But I think that when you look at some industrial facilities and power plants that have a more diluted CO2 stream, they're going to probably need some level of funding from the government to nudge them into an economic zone. It should also be noted that we do see a line of sight on the voluntary carbon offset market. Europe has had this for many years. It's I think it's $50 to $100 a ton right now. We're actively monitoring that because right now it's very nascent. It hasn't really established itself in a efficient way in the US. We're seeing some deals that are $5 to $10 a ton. But we do think that as these carbon capture and sequestration projects actually come online and prove themselves out as probably the most secure way to decarbonize industry, that's going to fetch a pretty high premium from other industries that physically can't decarbonize, like tech and the financial industry.
Cool. Thanks, Nicholas. So before, when I talked about gold hydrogen and I talked about the cost, our preliminary economics being $1 per kilogram of hydrogen. That doesn't factor in the 45Q tax credits. So, you know, that lowers the price even more and really makes this a even more exciting and, you know, easy to justify a project for oil and gas companies to jump into our joint industry partnership. So that makes it a lot easier. I guess the other thing to mention is the actual microbial process of this, of the using of the hydrocarbons that are remaining in your abandoned or depleted well. The actual microbial process is pretty cheap and pretty effective. So you're getting hydrogen off effectively and cheaply, but the expensive part is the capture of the CO2 as it comes out of the well and the re-injection or re-sequestration. So that's where, yeah, potentially infrastructure bills that are supporting CO2 sequestration could really help even improve the economics even further of this project.
Perfect. We're coming to the end here, but I want to finish the last topic about partnerships. And Ammonia, we'll start with you. You know, we heard from a lot of startups here today, I'm sure many of which would love to partner with Oxy. So I'd love for you to just talk about Cemvita's strategy in getting partners. You know, how did you come to get these partnerships? And what were the terms of the deals? And kind of how did you build those relationships to get where you are?
Yeah, I mean, we were very fortunate. Our seed level investors were Occidental Petroleum and BHP. Now for Series A, we have some people like Sumitomo and Mitsubishi as investors, as well as they are conducting projects with us. And that's been hugely helpful. I think what's really helped probably our team is we do have a number of folks in the team that really do have deep industry experience and connections. And also people that have the ability to sort of bridge deep tech and industry and bring that together into a sort of a compelling story and help companies such as in the oil and gas and the mining industries sort of take that leap and go on that journey with us. I think the other thing that we have going for us at the moment, and everybody has going for us at the moment, is that there's just such a movement and a pressure for companies to be cleaner and greener and to be innovative. And there's a lot more people sort of jumping on board and trying, you know, different ways of working with startups. And, you know, we are all growing on that journey.
Wonderful. Next, we talked a little bit about the ADM partnership. I'd like to focus now on the CPP partnership. You know, we see a lot of institutional investors trying to get serious about, you know, climate investments. I know you guys had a relationship at Wolf Midstream with CPP, and, you know, Wolf Carbon Solutions was kind of born out of that relationship. I'd love to just hear more about, you know, how that story came to be and the role CPP played in, you know, the formation of Wolf Carbon Solutions.
Sure. So CPP has studied the energy transition space and various technologies for several years, and they recently rebranded their energy group as Sustainable Energies Group, and so their kind of mandate in both Canada and globally actually is to really put more capital to work behind you know, the new frontier of energy. As I mentioned before, they're an infrastructure fund, so they like larger projects that have lower risk or proven tech technologies. So you know, Wolf and our team has a strong history of infrastructure development. So it's a nice marriage because, you know, we've already done it, as I mentioned, up in Alberta. We've built, you know, the carbon capture, transport, and utilization system in Alberta, and so they've got a lot of trust in our capabilities to replicate this down in the U.S. It fits their mandate from an infrastructure standpoint and from a risk-reward standpoint, and they want to do it through Wolf because of our history and what we've done over the many decades that our team has worked together.
Makes sense. Okay, last question for me for the day. It's EnerCom 2027. We're back up on the stage together having the same conversation. What has happened in the past 5 years and where are you looking to go in the future?
I'll take this one first. I mean, I'm gonna get on the soapbox for a second because I think that, you know, there are corners of the energy transition market or industry that seem to miss the transition word. And they're really focused more on energy overall. And so they're rushing to like replace coal and gas power plants with solar and wind, regardless of economics, regardless of feasibility. We're looking at direct air capture, which I love the technology. I think it's got a lot of promise over the next 10, 20 years, but it's just not economic at all. It's $200 a ton, maybe more. What we need to do, and I think the capital markets are starting to drive this, is really focus more on the true energy transition, which is taking the trillions of dollars of infrastructure and industrial facilities that we built over the past, you know, many decades, and decarbonizing it with proven established methods like carbon capture and sequestration. And so I think, you know, 5 years from now, we're going to see a little bit more pragmatism and realism behind energy transition. And I think, and also I think in 5 years, we're going to see some amazing technologies that we're tracking right now. I think they're going to start to fall into the commercial landscape or economic viability. And that's going to be really exciting because that's going to be the next step of energy transition.
Awesome. To you, Marty.
Okay, and just quickly, and I'm going to be specific to Vita. So in 5 years' time, I should be up here, you know, celebrating that we do have a commercial gold hydrogen, several facilities up and running. You know, they're producing hydrogen, and you know, and the sort of the hydrogen infrastructure that's needed to utilize hydrogen around the US and around the world is well established in place. Our project with Oxy on the production of bioethylene, that should be well established and a full commercial plant by that time. And I'm just going to do a little bit of a plug on the mining side, but I really hope that some of our biomining technologies that we're really, you know, supplying the metals that we need for our energy transition future. So one of the things that we're working on at the moment is lithium extraction. So lithium extraction from produced water, from brine, from clays, from some of these you know, more unusual sources. So in 5 years, I hope I'm standing up here also telling you about some successful commercial plants that we've got going as well. Thanks.
Awesome. Well, that's all the time we have. Thank you both so much for taking the time today. There's a lot of potential, a lot of uncertainty. It's great to talk with folks like you to try and figure it out. If you guys would join me in please giving them a round of applause.
Thank you. I really appreciate the discussion. I want to thank all of you for being here. Also want to thank and introduce, I know a lot of folks met him throughout the day and yesterday. Warner Kirk, who's with the university and head of the innovation side of things. They've been tremendous to work with, and I know he's got a couple of things to say, but really appreciate the partnership we've established here.
Thank you, Aaron. I don't want to take a lot of time. I just wanted to say thank you for coming. We're happy to host you. And in future years, we hope to host again. Next year, hopefully in our new innovation hub, a 30,000 square foot makerspace. And in 2 years in our new venture center, again, a 30,000 square foot business incubator and accelerator. Lots of fun things coming out of Mines right now. It's a great time. If you haven't enjoyed the campus, maybe we'll try to do it a little later in the year so you can actually wander through the green fields. But hope you can enjoy the rest of your time here and thank you for coming.